Sir, we are not able to hear you.
Good morning. Those who are online, can you hear me?
Yes, sir.
Yes, sir.
Thank you.
Yes, sir. We can hear you.
That's good. Okay, I hope you are all fine.
Yes, Professor. Thank you.
Professor is not audible.
Hello.
Like this. So those are online. Is it okay now?
Yes,
sir.
Professor.
Yes.
Slowly. Okay, those are online. Can you hear me right?
Yes, sir.
Okay, thank you. So before we proceed with the financial statement analysis, one of the classmates of you sitting in the classroom is asking a small doubt. Her concern is there are three type of transactions he's coming across. One is purchased goods from Mr. X on credit, purchased goods from Mr. X for cash. And one more type of thing is purchased goods from Mr. X. In one case, it is given for cash. In another case, it is given on credit. In the third case, nothing is given. Purchased goods from Mr. X. In real life, we can go and ask the purchase manager, how did you buy? How to ask the cashier, how did you buy? Cash, did you pay or did you not pay any cash so far? We can ask, but in exam, we can't ask anybody. So we have to assume. So normally, there is a practice. If name alone is given, there is no cash or the word credit there in the particular sentence. Example, purchased goods from Mr. X. No further clarity. For cash, by paying check, on credit. These three words are not there. That time you have to assume it is on credit. If name is given without the word cash or without the word bank, then we assume that the transaction is on credit. That's why they have not given any, that's why they have given the name of the person. Otherwise, goods purchased for cash rupees 20,000, that's enough. That X is not required. Okay, clear to you? Yeah. This is from journal. One of your classmates is asking it out, so I'm just telling it. Okay, come back to the discussion of today, that is financial statement analysis. So I was just telling you before, we have prepared financial statement, that is profit and loss account and balance sheet according to the Indian Companies Act 2013, if you are a company form of organization. Now it is the duty of an analyst or an investor or an academician or a researcher to just analyze the performance of the companies. We already discussed in the beginning, the performance of the company is nothing but profit or loss, right? Profit. The company might have earned profit or it has suffered a loss. So we have to check whether it is performing in a better manner or it is having any kind of drawbacks or any kind of lacuna or any kind of area of improvement. So we're going to analyze. I'm going to compare myself with myself in the previous years, or I'm going to compare myself with my competitor, my other rival companies, the same industry. There may be so many other companies. So I want to know where I am, what I am doing, whether I am doing it better day by day or I'm deteriorating in my performance. So performance evaluation is going to be done. Financial position is also going to be analyzed, and you're going to analyze the financial performance also. So this is called statement analysis, financial statement analysis. Why do we do financial statement analysis? First of all, what is financial statement analysis? Analyzing the data that are there in the financial statement. What are the financial statements? Two statements are there. What are they? Profit and loss account and balance sheet. These two are the financial statements. For this, we need financial statement. Of course, it is available in the website of each and every company. Okay, we already studied how to prepare such statements. Now we assume that statements are with us. We are going to scan through that statements. We are going to analyze. We are going to check the relationship between one variable with another variable, one data with another data, etc. Okay. So financial statement analysis is nothing but a process of analyzing the financial data that are found in financial statements, either in balance sheet or in profit and loss account or in both. Okay. Why do we do this analysis? What is the reason? Any idea? What do you think about this? Why? Who will do it? And why do we do it? Why do we analyze the financial statement of a company? Under loss or profit can be revealed by profit and loss itself. No, profit and loss account itself. You can see just profit and loss account and you can come to know whether the company is in profit or loss. To find out the performance in comparison to others or in comparison to myself in the past. Okay, or to find out where I am lacking. Okay.
Whether it is against our budget, whether it is exceeding or is what
Budget, that is altogether a different one. That's, yes, of course, that's also analysis. Okay, budgeted expenditure is there and real expenditure is there. We are comparing the budgeted with real. Okay, that is not found in the financial statement. Financial statement is nothing but a statement which is a record of past events. Budget is different. Based on budget, you are spending. Sometime you planned to make an article by spending 20 rupees, but you are making an article by spending 18 rupees itself. Budget cost is 20, actual cost is 18. So this is something different. Of course, this is also coming under management accounting or analysis of accounting data. But here, analysis of only financial statement. This is called variance analysis. What Sir is mentioning is actual is compared with the budgeted one or standard one. Standard is nothing but budget. Okay, standard. We are fixing a standard and we are producing. How much is the actual? How much is standard? We are comparing these two. Okay, that is called variance analysis, or we can call it as standard costing. Okay, that is not we are discussing now, but similar type. Okay, what is my sales in the current year? What was my sales in the last year? Is there any increase in the sales? That increase in sales is only because of price increase or performance increase. Last year my sales was 1 lakh. Current year my sales is 1,10,000. It does not mean that you are performing better in your sales. This may be because of last year selling price per unit is 10 rupee. Current year the same unit selling price is 11 rupee. Because of that, your sale amount is increasing from 1 to 1.1. That is not the increased performance of the marketing department or sales department. It's because of inflation. You increase the price. Cost has increased, you increase the price. Okay, so increase in price, whether there is increase in real sale unit, you have to check that. Okay, so there are so many other reasons. Anybody from online? Why do we analyze the financial statement of a company?
So to assess the continuity of business,
Continuity of the business. What do you mean by continuity?
whether the business will hold good for the next year planning and.
Okay. Anybody else? Continuity. How I am continuing my business. Okay, fine. Any other point? Anybody else?
And to know the performance of the company.
To know the performance. Can you decode it a little more? Can you explain what exactly you mean by to know the performance of the company? If it is just to know the profit or loss, I need not analyze the P&L account. I just refer the P&L account, I can come to know what is the profit. Performance analysis, to analyze the performance. Whether my performance is okay or not. So I secured 20 marks out of 25. To know the performance, just know the mark is enough. But whether you improved your performance or not, that's what analysis is required. What about your friend's performance? Sir, my friend has secured, the class average is 18. My mark is 20. So you outperformed the class. Yeah, planning for future, that's different point. But this is just checking your performance with the average, industry average. Suppose IT industry in 2021-22 financial year has earned a profit of 20%. The average rate of return in IT industry is 20%. As a company, Infosys, what is your average? What is your rate of return in the particular year? Sir, I have earned 30%. So you outperformed the market. So in order to know this kind of performances, detailed analysis. Okay. Any other point? He's telling planning for future. Okay. How the sales is increasing. So there is a constant increase in the sales. So I have to plan for that also. Manpower is required. I have to produce further also. So for planning, good. Any other point? What else necessitates the analysis of performance? Yes, sir.
To
To know
know the position of the company, sir. Position of the company.
To know the position, we have a balance sheet. Assets are there, liabilities are there, equity is there. To know the financial position, whether it is increasing, the position of the company is still, the company's financial position is sound or not. Knowing the position is simple. We can see from the balance sheet. What is your total asset? What is your total liability? What is your total equity? That's about financial position. But comparing the assets with liability. Sir, my total asset is 2 lakh. My liability is just 1 lakh. My equity is another 1 lakh. Whether these 3 proportions are okay or not. 2 times of asset is represented by 1 time of liability and 1 time of equity. There may be another company. Their assets are just 1 time. Okay, their assets are 3 times. Okay, 1 time is liability and 2 times are equity, or vice versa. 200 rupees is the liability, 100 rupees is the equity, and 300 rupees are the assets. So whether there is some kind of sound financial position in the company or not. All the time these two are going to be equal. L plus E is equal to A. Liability plus equity is equal to assets. That we already studied. Okay. So how that position is, not to just know the position, how the financial position of the company is, whether I am eligible to borrow further. If you're going to a bank, they will immediately ask you to produce these statements in order to assess your position, assess your performance, so that they can give loan or they can tell no. To take a loan from a bank, as a company, you have to produce all these documents. They have some team of analysts. They will be analyzing your statements and they will be taking attention whether the company is worth giving loan or not. 2 things. One is your financial position should be sound. Another one is your earning capacity should be there so that they will get payment in time, interest payment in time, and principal payment at the last in time. Okay, so there are so many reasons and there are so many parties who are interested in this financial statement analysis. I would like you to recollect the beginning class, that is users of accounting information we discussed, internal users and external. All those parties are interested in analysis of financial statement of a company for varied reasons. Government, why government, such an example, why government is interested in analyzing your financial statement? Whether you are properly maintaining your accounts, whether you are recording everything is properly, are you paying the required tax as per the law? Okay, or are you monopoly in the market? Do you control everything in the market? You are exploiting the customers. So for very many reasons, they are interested in your financial statement analysis. Researcher, owner, okay, employee, everybody. Those are all interested in financial statement analysis. Okay, now come to the point that is very important. What are the tools available for financial statement? See, there are many tools available. It's not only one tool what we have to analyze the financial statement. It's based on the purpose for which you're analyzing. The tools are there. We can't apply all the tools for all the purposes. The purpose decides what tool you are going to apply. So in general, we are understanding there are so many tools. First and foremost tool is common size statement. Please, I don't have that slide in the screen. Please write it down. Common size statement, comparative statement. Common size, comparative, common size statement, comparative statement, trend analysis. Trend. Third one is trend analysis. Trend analysis. Then another one is percentage analysis. Percentage analysis. Next one, fund flow statement. Fund flow statement. Fund flow statement. Then another one is cash flow statement. Cash flow statement. There are many. We are taking only very few and important one. The last one is ratios. Accounting ratios. Last one, accounting ratios. So in our curriculum, in our syllabus, we are going to concentrate only on the last one, which is a powerful tool. Everybody commonly use it. For many reasons, we use this last one, that is called accounting ratios, or you can colloquially call it as ratio analysis. So whatever you have noted down so far are the tools of financial statement analysis. Okay, I request you to go through any website or any textbook for the previous, for the 5, 6, whatever we had noted down. We are going to discuss only about ratio analysis. Clear? Okay, so we discussed the introduction, why should we analyze the financial statement, who will analyze it, and what is financial statement analysis. Now we are discussing about tools for financial statement analysis. Next, we are coming to applying a particular tool called accounting ratios. So what is ratio? Why it is required? How do I apply? What is the use of it? What are the different ratios? How do I calculate it? From the number of accounting ratio, what I am going to understand? How do I interpret the result of one ratio? These are all the things we are going to discuss today in this class. Okay. So accounting ratios. What is ratio? First of all, forget about accounting. In general, what is ratio? Anything that could be dividable. Okay. Yes. Comparison of two things. Okay. Fine. Mathematical comparison of two things. Okay. Anything else? Ratios. The relationship between two numbers, related to numbers. That's called mathematical expression of the relationship between two related variables. Is called as two related variables. Is called as ratios. Now that two related variables happen to be accounting variables. That's all. So that can be called as accounting ratios. Okay. So accounting ratios are nothing but the mathematical expression of the relationship between two related accounting variables. Okay. Why do I calculate? Why do I try to express mathematical relationship between two accounting variables? To find out the relationship between that two accounting data or two accounting variables. Say for example, simple. I'll ask a question. There are two companies, A Limited, B Limited. A Limited's profit is 50,000 last year. B Limited's profit is 60,000 same last year. Now, if I ask a question, which company is performing better? What is your answer? B Limited. Why? Simply you are telling 60,000. Sir, everybody knows simple mathematics. 60,000 is greater than, more than 50,000. So that is B Limited is performing better. Anybody is having any better answer or any different answer?
Sir, Vijay here.
Yes, sir.
Can you hear me?
Sir?
Hello?
Yeah.
Can you hear me?
Yes. We are able to hear you.
Place where my network is very low, so I just wanted to check.
No problem. Continue. Yes, we are able to hear you.
Yeah. So, but it's not just the 50,000 or 60,000. It is the investment versus the profit, right?
Okay. So you are not accepting simply 60 is greater than 50. Mathematically, okay. He is telling okay. But for how much investment company A has earned a profit of 50,000? What is the investment of company B, out of which it was able to manage the earning of 60,000? Good. He is comparing the investment with the profit. Okay, let me give an example now. I'll reveal another data. He's asking another data normally. He's asking another data. What's the investment, sir? Both the companies invested 1 lakh rupee. Now your answer holding good. Both the companies' investment is 1 lakh. So your answer holds good. There is no change in your answer. Similar, simple example, your class. Okay, your mark is 20 out of 25. Your friend mark is 30. Who is better now? 20. Because we don't know out of what she has secured 30. 30 out of 30. She has secured 30 out of 30. You secured 20 out of 25. Now who is performing better? You or your friend? Your friend. 100%. You got less than 100%. Simple. So out of what your performance is, that is not revealed in financial statement as it is. We have to go and analyze it. Profit is there in the net profit. In the P&L account, profit is there. 50,000, 60,000. Simply by taking that profit into consideration, if you say a decision which company is doing good, we can't simply come to a conclusion that that company is better. Yes, sir?
Vehicle number KA03 MA 3458.
3458. Anybody?
3458. Car number.
Car. Yeah. 3458. Just to hold on, those are online. It's yours. Yeah, please check it. Okay, so the base is required. Out of what your profit is. Sir, my gross profit, my profit is 10 rupee. Out of the selling price of 20 rupees. Another company is having a selling price of 30. They're also having a profit of 10. So these are all comparisons. So basics should be brought into percentage. Then we can easily say percentage. So we are going to do all these things in accounting ratios. The comparison is easy. If it is not in absolute term, if it is in percentage term, it is easy. Sir, my percentage in accounting for manager is 75. My friend percentage is 70. Easily we have a comparison. It's comparables. Okay. Out of 50, out of 75, the marks are there in front of me. Then I can't simply compare and tell who is better performing. I have to convert that in a common term. That common term is 100. So just an example for one of the ratios. So now sales is 100 rupee. Okay, sales is okay. Take sales 1000 rupees. Profit is 200 rupees. So what is the percentage? Please. What's the percentage? 20% profit. This is called profit ratio. Net profit ratio. Net profit is being compared with sales. The gentleman who was online, he was telling, profit and net investment. Profit and investment. So he is talking about investment and profit. Return on investment. So like that, there are so many variables are connected together. We are going to find out such relationship. Simple example, in your profit ratio, one company's profit ratio is 20%. Another company's profit ratio is 30%. Now we can say second company is performing better. So in terms of percentages. So ratio cannot be always in percentage. Ratios are in numbers, ratios are in times, ratios are in decimal, ratios can be in percentage as well. Okay, we are going to discuss all those things one by one. So there are group of ratios. Ratios are not one. And one more thing you have to keep in mind, we are discussing here only the quantitative aspect of a company. There are so many things, qualitative aspect. Okay, see, we have a blood pressure measured and the standard is there. Sugar level, blood sugar level is there, standard level. We have that. Okay, suppose the doctor is sitting in third floor. Okay, the lab is in third floor. The patient is just walking the steps and going there, reaching the third floor and giving a blood pressure, okay, check. That time he may be having a abnormal one because he's walking and going, he's taking some strain. He's simply keeping, sir, 72 should be there, but we are having 100. So you are a patient, you just go and get admitted. That kind of decision, if you take, that may sometimes lead for some kind of illogical conclusions, illogical inferences. So it's only quantitative aspect you are referring here, we are discussing here, we are studying here, and we are fixing a standard and we are comparing the actual with the standard. Say, for example, industry average in IT industry profit is current year 20%. Okay, I'm having 15% only. If you say immediately you are not reaching the average level of the industry, if you say immediately, then there may be a wrong. I'm not telling it is always wrong. There may be a wrong because you just started 9 months before. You are not performing 1 year. Your sales are less, or you are having some kind of accident in your company, or some kind of what you can say abnormal situation in your company in the last 2 months back. So that and all is not considered in the calculation of ratios. So as a doctor, you just diagnose the patient, and you cannot simply compare the actuals of the patient with the standard what is medical world is already fixed. You have to go and ask more and more questions to the patient, and you have to find out what is the reason for this. That reason is correctly attributable for this shortage or is excess. Then you have to take a decision what is the wrong. Similarly, you are all going to play as a doctor's role. The company is a patient for you, or company is a client for you. You are playing a role of doctor. You are analyzing the company's health, financial health. And before taking a decision, before you suggest something to the patient, suggest something to the client, you should be clearly confirming that is what is there in the company. Simply the ratio 30% is the average, but 20 is there in this company is not performing good. If you jump into a conclusion like this, that may not be a logical one. It may be misleading you. Ratios are not the end. Ratios are a mean to an end. I hope you're understanding what I'm telling. With the number of ratios what you're having, we can't jump into a conclusion without discussing the qualitative aspect of the company. That you have to keep always in mind before you take any decision based on the ratio analysis. Okay. Having said all these things, let us come to the different ratios. So before that, meaning of ratios, I just have told you. Yes, sir. Sorry. We have no much standard tools for qualitative analysis. But before you take a decision, you have to check with the company. You have to call the CEO or you have to call the board of directors and you have to ask what has happened the last. You are finding something abnormal in the company. Immediately, you cannot give a right recommendations. Who will do this in practice? Suppose you are going for issue of shares, or going for borrowing loan, or you are going to issue debentures. In these three cases, your company is going to be rated. Credit rating agencies are there. Anybody is working in credit rating agencies? There is a credit rating agency in Bangalore, Brickworks, Standard & Poor's. There are so many are there. Suppose you are a team of analysts. One client is coming to you. They have applied in your company. They want themselves rated by your company. Suppose you are CRISIL. Okay. Tata Motor is coming to you. They're giving a request. We want to get ourselves assessed by you. We are going for a borrowings in the market. Debentures we are going to issue, or we are going to issue further equity shares. Rate us. You are doing all this process. Only ratios are the tool. You are doing. After doing everything, you come to an idea. That idea need not to be immediately publicized or immediately handed over to the client. You have to call them and you have to ask for some more qualitative information. Okay. Based on that, you should take a decision. This is not the only tool you can use. Simply, you can come to a conclusion. That's what I'm trying to say. There is no such qualitative tools available for us. Okay. Of course, qualitative is somehow subjective. Again, subjectivity comes into picture. You have to be very careful about the qualitative information as well as the ratio analysis result what you are having. You should not be biased. But many times the rating agencies are biased. If you are biased, then later your creditworthiness of, the credibility of you itself is questioned. Suppose CRISIL is assessing so many companies in the last 1 year, 100 companies were assessed. All the 100 companies are given good rating. When it comes to market will assess in real time. You are just in the books you are assessing, but market is the real assessor. Market is the real assessor. If they do not accept your rating, then your credibility is questioned. So you will not do that. You will not be withstanding in the market so far. So bias will not be long lasting. Okay. So keeping all these points in mind, come to this analysis. Look at this. A ratio is a mathematical number calculated as a reference to relationship of two or more related numbers, related accounting numbers. Okay. Mathematical relationship. Example, profit and sales, investment and sales, investment and profit. Okay. Borrowings and owned capital. Suppose I have 2 lakh rupees as equity, 1 lakh rupee as loan. So 2:1. 2 times of equity is backing 1 times of borrowings. So 2:1. So this kind of relationship we are going to fix. Okay. So it can be expressed in terms of fraction. Okay. 0.2 is the profit. Out of 1 rupee, 0.2 is the profit. That can be fraction. It can be expressed in terms of proportion, percentage, and just a number, So these are all the various ways in which the ratio can be expressed. Look at this simple example. 10,000 rupees is the profit and 1 lakh rupee is the sales. So the profit to sales ratio, we simply say as profit ratio, net profit ratio. What is net profit? Sales minus all direct and indirect expenses called net profit. Okay, so net profit upon sales multiplied by 100 is equal to net profit ratio. In this example, 10 divided by 1 lakh into 100, that is equal to 10%. 10%. So this is how we are calculating the ratios. Okay, this is already discussed. To know the areas of business where the business need to have more attention. Okay, then why we need to have ratio analysis? Ratio analysis is helping us to know the potential areas in which I am strong enough. Then it provides a deeper analysis of profitability liquidity, solvency, and efficiency. Please keep these 4 points in mind. This is the center of discussion for entire this ratio analysis. Ratios are helping us to know a deeper sense, a deeper understanding about what? About 4 things. What are those 4 things? Profitability of the company, liquidity of the company, solvency of the business, efficiency of the business. These 4 things are to be analyzed in detail. Before you say anything about a company, these 4 things need to be analyzed in detail so that you can tell something about the company's performance, company's position. Okay. Ratios are helping us to analyze these 4 in detail. What is profitability? No. Profitability is different from anything that is profit. Okay. Profitability, the ability of 1 rupee to earn profit, or the profit in connection to one related variable. How 1 rupee of sales, how much is resulting in profit? 1 rupee of investment in business, how it is resulting in profit? Ability means what? How a rupee invested, how a rupee of sales, how an employee is resulting for profit. Okay, profit ability. The ability of earning profit. The ability can be of a rupee invested, the ability can be of a sales made, the ability of employee in the business, or the ability of an asset in the business, anything. Okay, ability. Then liquidity, the cash flow. Okay, what is liquidity? More than that, liquidity. It's a common term what we are using in our colloquial life, no? Liquidity. What is the definition? What is the academic meaning of liquidity? The ability of converting an asset into liquid cash without delay in time and without loss in its value. Anything can be converted into cash. Under this world, anything can be converted into cash. Possible. But that is not liquidity. Sorry? You're selling goods, okay. Clearing goods. Clearing means what? You're taking it and dumping in BBMP. This one. Dump yard? No. Selling, clearance sales. Clearing sales. We are not talking about sales or something here. We are talking about the ability of an asset. See, everything is an asset for a company. What is owned, we discussed long back now. What is an asset? Anything which is owned and controlled by a business. It's called asset of that business. Okay. Any such asset which are able to convert into cash, which are able to be converted into cash without loss of time, without loss of value. Suppose this bottle is 20 rupees worth today in the market. If I am able to sell it within no time for 20 rupees, then this bottle is having a liquidity. That's it. Just like he's talking about equity share. Am I right? Yeah. Equity share is most liquid form of security. If you have an Infosys equity share today, tomorrow morning 10 o'clock, 9:30, you can just sell it in the market. So equity share is more marketable. Any asset which are more marketable is called having more liquidity. Ability of converting one asset into cash without loss in value, without loss in time. How quickly you are converting without loss? What's up? Continuous cash flow. It's not about continuous of one asset. Suppose there is a building. Every month I'm getting a rent from that building 1 lakh rupee. That's continuous cash flow, but that is not liquidity. If I'm going to sell that apartment, how quickly and how easily, without loss in value of the apartment, getting the cash by disposing it off, by selling it off. Okay, so most illiquid form of asset in the world is most illiquid. What is illiquid? Zero liquidity, or which cannot be easily converted into cash. If you want to convert it easily into cash, you have to compromise in its value. Okay, what is the most illiquid form of asset in this world? Most illiquid form of asset.
NPA.
NPA. Madam, in companies, NPA will be there? You're working in a bank?
No, sir.
No. Okay. So you are a borrower from a bank.
Yes, sir. You.
Yeah,
sir,
that's why you're talking about NPA. NPA is special nature of asset only for lending institutions. We are talking about manufacturing companies. So in manufacturing company, NPA won't be there. We are not
Okay.
lending money. Obviously, we are borrowing money. What is the most illiquid form of asset? Land and building. Land and building is the most illiquid form of asset theoretically. Sir, you can say one thing, sir, I have an asset near MG Road. On MG Road, I have a piece of property. How can you say it's the most illiquid form of asset? Tomorrow, if I keep a boat, tomorrow itself it can be sold. That is possible. We are not talking about that, but rate, value, negotiation, the price. Okay. In the real estate market, there is no reference point of price. In stock market, in equity today, if you say tomorrow I want to buy Infosys equity share, I have a reference point. What was the closing price of Infosys stock Friday 3:30? I have a reference point. Based on that, I can open my market in Friday morning 9:30. I can take a reference of this. I can place an order. But in real estate market, there is no such clarity. My friend may say 1 square feet near Banarkata Road, I bought it for 10,000 rupees. Who is going to believe that words? I don't know. How far it is believable? Yes, sir. How many of us are going with legal register? I mean, legal price for a registration? We can register at that guidance value, but market rate is different from guidelines rate. So nearby my home, the guidelines value may be 1,500, but it is really selling for 10,000 rupees or 8,000 rupees. And again, it is need based. I want that land because both the side I am there already. If someone is coming in between my two lands, I have my problem. So I want to buy that. So I'm ready to pay more. So demand, supply, need, situation, the urgent of the person who is selling it, everything is coming into picture. Then the price of the land is being fixed. So it is most illiquid. If I want to sell immediately, I can't. I have to wait. If I want the good rate, if I want the market rate, which I think as a market rate, I have to wait. So most liquid form of asset is in this world is
Cash.
Cash. It's already in liquid form only. Okay. So we are going to check the liquidity of the company, how the company is able to pay off its liabilities, how quickly the companies are able to pay off its liabilities, how liquid the company is. What is the liquidity portion of the company? You may be a big company, you may be having a lot of assets, but your rent is delayed by a day, your reputation is gone. Rent is only 1 lakh rupee per month for you, a small building, but you are not paying in time, you are not having liquidity. So banks which are going to give you loan will check for liquidity. Are you be in a position to pay interest or EMI in time? Okay, liquidity. Solvency means long-term liquidity is called as solvency. How are you good in your financial position in long run? Liquidity is short run. Today, how are you liquid enough? How are you quick enough to settle the liabilities? But solvency means in a long run. Suppose you're borrowing today money for 10 years. After 10th year, are you able to pay off your money or not? Solvency. Solvency means in the long run, how your debt and equity are related to. How much amount of debt you are having out of how much amount of equity. Owned money and borrowed money. Borrowed money can be more than the owned money, no problem. But how that relationship? Up to what you can borrow, up to how much you can borrow. What is your long-term liquidity position, long-term solvency? That is going to be analyzed. And efficiency. Efficiency means your profitability. I mean, how you are efficiently using your assets. How efficiently you are able to use your assets in generating income. That's called efficiency. So these are the things are going to be analyzed in detail. Then to provide information for making cross-sectional analysis, production to marketing, marketing to finance, HR to finance, such kind of decisions you can take easily based on this ratio analysis. Okay, there are so many theories, you can read it later. All these things will repeat. Let us come to the limitation. I already told you. One of the limitations I told you, you have to carefully use this tool. It may mislead if you just use that as a number. You have to take qualitative aspect also into picture. That's what is mentioned over here. See, ignore qualitative. It is ignoring qualitative and non-monetary aspects when it is analyzed. It's taking only number, qualitative. Okay. So this is about introduction. Now come to ratio analysis. The tools. Yeah. Look at this. We just now discussed about 4 things, So we can classify the ratios under these 4 categories. Ratios useful to analyze the profitability of the company. Ratios useful to analyze the solvency of the business. Ratios which are giving some deeper understanding about the liquidity of the company. Another ratios that are telling me about the efficiency of the company. So we can classify the ratios into so many categories. There are another group of ratios. The same ratios only will come under another group that is called balance sheet ratios, profit and loss account ratios. Meaning you will use only data from P&L account to compute some ratios. Those ratios can be called as profit and loss account ratios. There are another group of ratios which may come under any one of these categories. But those ratios are using only the data from only one statement, balance sheet. Then we can call those ratios as balance sheet ratios. Okay. There may be some ratios. One data is taken from P&L account, another variable comes from balance sheet. Those ratios we can call it as combined ratios. But that classification is not a logical classification. This classification is a widely used and logical classification. Based on the purpose for which I am using the ratio, I am classifying the ratios into solvency ratio, liquidity ratio, profitability ratio, and efficiency ratio. Is it clear? Any doubt up to this? Okay. One more thing. This is purely mathematics, actually. Those who are not even knowing accountancy, no problem. It's only division. 4 by 2, A by B. Only that logic. But what is to be A? What is to be B? That needs little accounting understanding. Okay. So let us see one by one all the ratios. First, we can go with liquidity ratios. Liquidity ratios, it's a group of ratios actually. Liquidity. Okay, liquidity is a concept of the ability of converting the asset into cash. To find out the liquidity of the company or a business, we have group of ratios. Those group of ratios are called as liquidity ratios. It is trying to measure the short-term solvency of the business. What is short-term solvency? Liquidity. How you are solvent? What is solvent? Solvent means what? No, forget about accounting. In general, solvent means in science. Anybody from science? Solvent and insolvent.
That allows thing to be to merge or to
Yes, madam?
dissolve. That allows thing to dissolve.
That
Medium.
does not. Okay. In dissolve, solving, dissolving. Okay. Solvent, dissolve, insolvent. Solvent means it is concrete. That means strong, concrete. Insolvent means just opposite of that. It's not concrete. It is getting dissolved. It is getting eroded. It is getting coming down day by day. Insolvent. Okay, I'm not good position, good financial position. That's called insolvent. My debts are more, my assets are less. That's called insolvent. Opposite of that. I'm very much solvent, means I'm sound. Simple colloquial language is I'm very sound in my financial position. It's called solvent. I'm solvent. This company is good in solvency. That means they're okay. They can manage. There is no problem for them. There is no financial problem for them. That's the meaning. So solvency, short-term solvency is called liquidity. Okay, let us come to the ratios one by one. First ratio under the liquidity ratio is first ratio under the family of liquidity ratios is current ratio. So what is current ratio? Current ratio is nothing but a measure of current assets, the relationship between current assets and current liabilities. So here the formulas are important. You have to remember the logic of that equation. Look at this equation. Current asset divided by current liabilities is equal to current ratio. Current ratio. What are current assets? We already have in the balance sheet under the heading called current assets. Example for current asset is cash
Stock
in
on
hand,
hand.
cash at the bank, short-term investments, sundry debtors, bills receivable, accrued income, prepaid expenses, etc. These are all the examples for current assets. Where you can find the current asset? Balance sheet under a heading called current asset. Okay. Divided by current liabilities. What is current liability? Any liability which need to be settled within one accounting period of time at a maximum is called current liability. Example for current liability? Example for current liability is
Bills payable.
bills pay. Okay, example for current liability is outstanding expenses, income received in advance, bills payable, sundry creditors, accounts payable, bank overdraft, short-term borrowings, anything payable, income tax payable, electricity bill payable, outstanding, all outstanding. Okay, these are all called as current liabilities. You have to take the total of current assets of a company on a particular day, and you have to take the total of current liabilities of the same company on the same day, and you have to divide the assets by liability. You will get an answer. That answer is called as current ratio. Can you just try a ratio for this? Inventory. Yeah, we forgot to tell about inventory. Inventory is a current asset. Inventory, stock in trade, inventory, and then trade receivable, current asset. Advance tax, current asset. Cash and cash equivalent, current asset. Trade payable, current liability. Short-term borrowing from a bank, current liability. So 1,04,000 is a current liability. Remaining all are current assets. So take the current asset total and take the current asset, current liability total and divide them. So 1,34,000 divided by 1,04,000, it is equal to 1.29 is to 1. What does it mean? 1.29 times of current assets are representing the 1 times of current liabilities. So current assets are more than current liability. Actually, it is standard norm. Standard current asset ratio is 2:1. 2 times of asset, 1 time of current liability. Okay. Is it in doubt? Is there in doubt in the first ratio? Okay. Second one is quick ratio. Second subtitle of the current ratio. Second ratio under the family of current ratio is, under the family of liquidity ratio is quick ratio. Just a variation from the current ratio. Just a variation. Small variation, that is quick assets divided by current liability. Instead of taking total current assets, we are taking only quick assets. Then what is quick assets? From current assets, we can minus two things. One is prepaid, another one is stock. If these two are minused, we can call that as quick assets. Total of current assets minus prepaid expenses and stock, inventory. If you exclude these two from current assets, you will get a total. That total is called as quick assets. So quick assets divided by current liability is called as quick ratio. It can be otherwise called as acid test ratio. It is more stringent in measurement. In the first case, we include all the current assets into picture, all the current assets. But it is going little more stringent. Stringent means little more strict measurement. Meaning, the prepaid expenses are prepaid. That's all. We can't go and ask the person, sir, I already paid you some money. You give my money back. I have some emergency. You cannot give. You will tell what for you prepaid, take the service. Suppose I prepaid some expenses for Viscom bill, only 1,000 rupees. I paid 10,000 by mistake. 10,000 I paid. 9,000 rupees, can I go and get it from the Viscom now? No. What they will tell? Another 9 months, you use the service, take it, don't pay the bill those days. Advance payment. So I can't get back. So that money is not with me, even though it's my current asset according to accounting, but the money is not going to of any help for me. Similarly, stock. Stock is there in my company. Warehouse, I kept stock. If I don't find the customer where I can sell the stock, to whom I can sell the stock, I can't. So that's also current asset, but not that much liquid. It is illiquid than that of other current assets. Bills receivable is there. What is bills receivable? Somebody has to pay money. He has written a bill of exchange and given to me by promising that he will pay the money after 2 months. If I need money, I can go and demand him. Sir, I have some problem. Why don't you advance your payment? 2 months waiting time, okay. But now I have a problem. Why don't you give back? Bank balance. It's my money. Cash balance. I can spend whatever I want. Debtors, I can call them and ask. Sir, you've taken a goods, please pay up the money. So that is why we are calling it as quick assets. So quick asset divided by current ratio is called as quick ratio, otherwise called as asset trust ratio. Okay. The standard ratio is 1:1. Standard ratio is 1:1. Fourth, yeah. Quick. It's current asset. Current asset also coming under. Only thing is two things you are minusing from your current asset to find out the quick assets. What are the two things? Prepaid expenses and inventory. If you exclude these two from the current asset, everything is called as quick assets only. No. How come it is there? First year student and first year student of Dayanand University and student of Dayanand University. Same only. But there's some difference. Come accounts little later. First, my example is student of Dayanand University, first year student of Dayanand University. Both are same or not? In one logic, same. But really speaking, it is not necessarily to be same. No. It will be combination of all the 3 semesters. Student of Dayanand University. First year means only first year. So, bills receivable is the outcome of debtor. Suppose I am selling goods to you. You are on credit. You are becoming a sundry debtors for me. Trade receivables for me. Okay. If I keep just like that, you are always a trade receivables for me. You are a debtor for me. But I don't believe you. What I am asking, you give me in writing that this much you have taken goods from me and you are going to pay that money in the future. That becomes bills receivable. Bills receivable is a document actually. It is not for every customer. It's only for those customer from whom I am demanding it. Why I am demanding? I am not believing you. I'm not having a faith on you. I'm doubting your repayment. I'm not telling that. That could be one reason. But main reason is I can go to the bank and I can discount the bill. I can't go to the bank and I can tell, sir, Mr. X is my customer. He has taken goods from me. He is my debtor. Collect money from him later. You give me money today. No bank will give me. Bank will ask me, what is the proof? I can give the invoice. Invoice is between you and the customer. What is the evidence for me? Then I'm creating a document. That document is called as bill of exchange. So you are writing, I am writing a bill on you. It's not invoice, bill, separate. Okay. Just like a promissory note. I'm writing it and you are signing that document and you're giving to me. One copy you are keeping with you. For you, it is bills payable. For us, for me, it is bills receivable. I will take this paper to my bank where I'm keeping my current account. I'll give this paper, sir. There is there is a person called X who is our customer, taken goods from us on credit, promising the payment in the 2 months later. For that, this is an evidence. Take this bill, take this bill of exchange, take this negotiable instrument, give us money immediately. You collect it from him later. Okay, this process is called as bills discounting. This cannot be possible only if you are a debtor. Now, from the books of accounts, from debtor, your name will be removed. Your 1 lakh is relieved from debtor. Your 1 lakh comes under bills receivable. Like this, I might have collected bills from many customers. All the bills, I will take it and go to the bank and give. It makes my current working capital arranged easily. If you're simply a debtor, I have to go and borrow loan from the bank by hypothecating something or mortgaging something or by arranging some other overdraft facility. But this is giving business for the bank. How the business is earning out of this? 1 lakh rupee is the bill of exchange amount. The bank will not give me 1 lakh rupee. It will give me only 99,000 rupees or some amount. The difference between that is the income for the bank. It's waiting for 2 months or 45 days. It will take from you. So that's the income for the bank. That's called bills receivable. No, no, that is different. What you do in what 2 things are telling? Letter of. Okay, what you will do in that? Letter of credit and letter of debit. Okay. It is between whom? Educate me what it is actually. One of you. Yes. Yeah. Customer to the vendor. Suppose I am, one second, let me understand slowly. I am the company in Bangalore. My customer is in Delhi. I'm going to sell some goods to the customer who is in Delhi. This time, who will be issuing the letter of credit? Delhi customer will go to his bank and request a letter of credit, right? He will collect that and send it to me. Why this is? Because I do not know who are you in Delhi. Okay, the ICICI bank where the Delhi customer is keeping an account will issue a letter of credit to the customer. Customer will send that to me. It is not compulsory. If I am ready to take risk, okay, whoever it may be, I believe the businessman. Okay, I want customer. So I'm selling to them without even letter of credit. Okay, this will happen mainly in the foreign trade. Okay. Because here I can trace it out. I can immediately ask one of my friend who is already there in the customer in Delhi. I can ask. Suppose I am the Christmas star is there. No, my friend is doing that Christmas star making. Okay, he is distributing to the entire India. He just a third standard or second standard. Okay, what he will do is he will just make a call who is already a customer for him, a reputed customer for him, and he will ask. There is one person the same locality is asking a credit. Can I give or not? What is your opinion? It's not legally binding them. Suppose he's telling, yes, you can go ahead. After giving, this customer is absconding. The existing customer who has given a word about that new customer is not legally bound to repay the money. Same thing is applicable to your bank. Instead of asking my customer, I am asking a bank which knows about the new customer whom I am going to newly trade with. It is not bill of exchange. In that case, banks are not having any legal obligation. Bank will tell, have you seen the letter of credit? You might be seen. They will introduce your customer. That's all. Is so and so having a business in this, that number, GST number, all those things, and his registration number, everything. He is our customer for so many years. His position is satisfactory, or his position is good. Like that, they will give a opinion. That's called letter of credit. LC. Okay, what is LT then? That time it's legal obligation. That comes legal obligation. Okay. You are depositing some money in the bank and bank is giving a guarantee. That's bank guarantee. Bank guarantee. Okay. That time it's legal obligation. Up to how much I have given a bank guarantee, that is legal obligation. Beyond that, if I sold goods out of my greediness to earn more profit or retain the customer, if I get any later on absconding of the customer, then I am only out to bear that loss. Bank will not come into the picture. This is normal. Okay, this is only at the time of new customer. If the LC is given for ex-customer for last 1 year, 1 year he is dealing with me. After 1 year, he is becoming my friend. He is becoming my existing customer. Then I should be in a better position to assess his credit worthiness than that of any third party. Okay. Right. So this is called quick ratio. Next one is, okay, this we can play with the number. There are so many. One example we can take. Look at this question. X limited has a current ratio of 3.5:1. The answer is given to you. The ratio is given to you. Just a mathematics. And quick ratio is 2:1. Two ratios are given to you. You know what is two ratios? Current asset CA by CL is equal to current ratio. Quick asset by current liability is equal to quick ratio. Answer for these two is given to you. And they're asking a question. If excess of current assets over quick assets represented by inventories is 24,000, meaning there is no prepaid expenses. Only difference between current assets and quick asset is only one, that is inventory. In general, inventory and prepaid. But in this company, prepaid is not there, only inventory is there. Okay. Calculate the current asset and current liability. Can you do it? Answer is there in front of you, but can you just think of how it can be done? Look at this. Current ratio is 3.5:1, quick ratio is 2:1. So the difference between these two, if you take current liability is equal to X, current asset is equal to 3.5 times of X. Will you accept? Current liability is equal to X means current asset should be equal to 3.5 times of X. Are you able to come to this logic? current asset, how it can be 3.5 times of X? 1 time is current liability. 3.5 times is the current asset. So if X is equal to current liability, if 1 is equal to X, 3.5 is equal to 3.5 times of X. Okay, mathematics, simple mathematics. So 3.5 into X. If that is the case, what is the quick assets? How do you find out quick assets? Quick ratio is given. Quick ratio is given. Quick ratio is equal to quick asset divided by current liability. If current liability is 1 time, that is X, then quick asset is already given the question. Quick asset ratio is 2 is to 1. So X is 1 means 2 is equal to 2X. Okay, 2X. So current assets minus quick asset is equal to inventory plus prepaid. But in this case, prepaid is not there. So current asset minus quick asset should be equal to inventory. So 3.5 times of X minus 2X is equal to inventory. That means 24,000. If we solve that equation, 1.5X is equal to 24,000. So X is equal to 24,000 divided by 1.5. 24,000 divided by 1.5. That is equal to 16,000. What is X we have taken? X is nothing but current liability. If X is equal to 16,000, current liability is equal to 16,000. Then how much is current liability asset? Current asset is equal to 3.5 times of liability. So 3.5 is to into 16,000, that is equal to 56,000. Just a mathematics, nothing is there in accounting. It's only mathematics. We're trying to find out how much is the current assets based on these two ratios. These kind of questions also may be there, but it does not serve any purpose as such, but maybe there. Okay, to test your mathematical or understanding of 2-3 concepts together. Okay. Next, come to the next group of ratios, solvency ratios. What is solvency ratio? Any ratios which are useful to understand or measure the long-term solvency of a business is called solvency ratios. Okay. What are those? The group of solvency ratios. Long-term solvency of a business can be evaluated by debt equity ratio, debt to capital employed ratio, proprietary ratio, total asset to debt ratio, and last one, interest coverage ratio. Interest coverage ratio. One by one we can discuss. Debt, what is debt here? Debt means the long-term borrowings. Equity means shareholders fund. Okay, so the first ratio, debt to equity ratio is equal to debt equity ratio, debt to equity. A debt equity ratio is equal to long-term debt divided by shareholders fund. How do you know these two things? Both are from balance sheet. In this ratio, both are from balance sheet. We can take long-term debt as well as shareholder fund from the balance sheet. So if a company is having 2:1 as a ratio, debt equity ratio is equal to 2:1, that company is said to be a long-term solvent company. 2:1, 2 times of debt and 1 time of equity. But it may be very, see, I'm just telling you, it's only a standard. Okay, you cannot just take that standard for all the companies all the time. You have to look for individuality of the company. Suppose BP level is 72. There is some person who is very much strong enough, he is having only 60. You can't go on telling, no, BP is according to medical, this one, 72 should be there, but you are having only 60, you are a patient, come. You can't take it. He is already solvent, he is already good, he is already strong enough. He is doing all his activity on his own, he is strong enough. So your medical is proved wrong there. Meaning he is having some kind of extra, that's average, medical, that's average only, 72 or 100 or your blood, I mean this blood sugar, all these things are average. By taking by and large, they put an average, fix an average. That cannot be always strictly, if you draw a line, who are after this line is patient, then that is not possible. You have to go by case by case. But general is there. General is there. So 2:1 is the safest form of equity ratio, debt equity ratio. Okay, what do you mean by shareholder fund? Shareholder fund is nothing but Share capital plus resource and surplus plus money received against share warrant. Okay. Share capital means preference as well as equity. Okay. Then what is share? Shareholder fund. How to calculate another way? The other way of calculating is add all the assets, non-current assets plus working capital minus non-current liabilities. That is also called as shareholder fund. But the first thing is better, easy to understand. We have a balance sheet. In the balance sheet, we have share capital, we have resource and surplus. Add that two things, that's equal to shareholder fund. Okay. Debt means what? Already I told you, debt means long-term debt. Okay. Look at this question. Look at this balance sheet. Can you tell me what is the shareholder fund here? Shareholder fund. How much? It's already given now. Shareholder fund. 15 lakhs. Look at this. 15 lakh is the shareholder fund. 15 lakhs. What is the debt? Debt in this question? Debt. Debt is, look at this, debt, long-term debt, 4 lakh plus 40,000 plus 60,000. So this is called debt, long-term borrowings, other long-term liabilities and long-term provisions. Under this point number 2, in the name of non-current liabilities, whatever is there, you take that as a debt for this ratio. Okay, so 5 lakhs is compared with 15 lakhs. 5 lakhs by 15 lakhs is equal to 0.33:1. What is the standard ratio we discussed? 2:1. 2:1. But what is here? So this company is loss. Basic purpose for which you are calculating this ratio is not to find out the company's loss or profit. Always in our mind, there are two only possible, loss or profit. It's not measuring about loss or profit. Loss or profit to measure, we have another ratio called profitability ratios. Here it is measuring the long-term solvency. So if you are a banker, how do you look at this company? If you are a banker, how do you look at the company which is having a debt equity ratio of 0.33:1, where you are having a standard ratio as, what is the standard ratio? We just discussed now, standard ratio. 2:1. If that is the case, what is your interpretation for this number? This number can be calculated by anybody. Anyone can calculate this number. Something divided by something is equal to that number. But the ability is how to interpret that number. What is the significance of that number? If you're a banker, what is your interpretation for this number? Sorry? Poor solvency. Repayable capacity. Okay, forget about number. Forget about the ratio. Look at the real data. How much is the debt? 5 lakhs. What is the equity? 15 lakhs. What is the solvency of this company? Very good. So much. But that is also not good for the company. Otherwise, you can take in this way. No. Where the assets are coming here? It is not using the capacity of borrowing. You are eligible to borrow. You are capable of borrowing. You are eligible to get loan, but you are not. For that, you cannot simply go and tell, sir, you are having good borrowing capacity, please go and borrow. After borrowing, what are they going to do with that fund? If the fund is used for generating more return than that of the cost of borrowing, it is advisable to borrow. Otherwise, that's it. But that's a comment. This company is capable of borrowing. It should explore the opportunity in which we can invest some money, which is giving them more return than that of the bank rate, bank interest rate or borrowing cost. If that is not found, then this company is wasting its potential. It's not efficiently run by the management. That kind of interpretation you can give. Suppose if it is 3:1, it is 0.33:1, so you are telling it's having more capacity to borrow money. If you are a banker, what is your decision now? Asset is, if the company is coming to you to ask loan, what is your decision now? You will give. Suppose this company is asking a loan of 30 lakhs or 25 lakhs. If this company is asking a loan of 25 lakhs, what will be the revised debt equity ratio after the loan is granted? If this company is asking 25 lakhs as loan, what will be its debt equity ratio after the loan is granted? It is that difficult? Mathematics. How it is 2:1? 25 lakhs plus 5 lakhs, 3 lakhs, 30 lakhs divided by 15. 30 by 15 is equal to 2:1. So that up to 25 lakhs, if the company is asking loan, the banker will not hesitate to give it. Suppose this company is asking 30 lakhs loan, that time the bank should rethink. For that, but bank can give loan. That means bank is taking risk. The company is also taking risk. Financially, the company is going to be risky. For whom? For the equity holder, the company is going to be a risky company. Why? More loan is there, lot of profit the company earns, all will go as interest. Nothing will come to shareholder as dividend. Provided the company is having capacity to earn more than the amount of interest what they are supposed to pay to the bank. So these are the various connotation you have to keep for one ratio. You cannot simply see the ratios in a number as a number. So this company is having good solvency. Second ratios under the solvency ratios is debt to capital employed. Debt to capital employed. How do we close this? Where from this? Where the file gone? Okay, so debt to capital employed ratio. By the name itself, you can understand what is the significance of the particular ratio. Debt is compared with capital employed. You already know what is debt. Okay, debt is equal to long-term debt. We just discussed. And what is capital employed? Capital employed is nothing but net assets. Net assets. Okay. How do you find out net asset? Net asset is nothing but total asset minus loss asset or the fictitious asset or waste asset. Okay. Look at this. Capital employed should be calculated by adding the long-term debt plus shareholder fund. What is the difference between the previous ratio and this ratio? In the previous ratio, long-term debt divided by shareholders fund. But here it is capital employed. What is capital employed and what is shareholder fund? Capital employed is nothing but shareholder fund plus long-term debt. In the previous one, you just calculated A by B. But here, it is A divided by A plus B. That's it. Simple. Simple logic. Shareholder fund plus long-term capital is equal to capital employed. Okay. So debt to capital employed is equal to long-term debt divided by shareholder fund plus long-term debt. Otherwise, you can say long-term debt divided by capital employed. It is you to remember this equation. That's it. Next one, proprietary ratio. Proprietary ratio. Very, very important ratio under solvency. Proprietary ratio. What is proprietary ratio? It expresses the relation. It is expressing the relationship between the proprietor's fund and the net asset of the company. Proprietor means shareholder. Shareholder fund and net asset. Okay. The equation is equal. The equation is shareholder fund divided by capital employed. What is the difference between this and the previous one? The previous one, shareholder fund plus long-term debt was the denominator. Here also same thing. Capital employed is the denominator. But the numerator is not the long-term debt. It is only shareholder fund. All these three ratios are connected to each other. The first ratio is talking about debt to equity, debt and shareholder fund. Second ratio is talking about debt divided by capital employed. Capital employed means shareholder fund plus long-term debt. This ratio is talking about shareholder fund and capital employed. Shareholder fund plus long-term debt. Okay. Any further explanations required? No. Total asset to debt ratio. Next one is total asset to debt ratio. Total asset divided by long-term debt. Total asset of the company divided by long-term debt. Okay, look at this particular question. We are asked to calculate debt ratio, asset to debt, debt to equity, proprietary, debt to capital employed. Can you calculate debt to equity ratio in this question? Debt to equity. Debt to equity ratio. What is the debt to equity ratio? Online people, are you there? Can you help us in calculating debt to equity ratio for this question number 9? The balance sheet is in front of you on the screen. Try finding out the debt to equity ratio. What's the formula for debt to equity? Long-term debt divided by shareholder fund. So what's the long-term debt in this question? 1,50,000. What is the shareholder fund? 5 lakhs. So 5 lakhs and 1,50,000. So answer is 0.3:1. Okay. Next. Total asset to debt ratio. Total asset to debt ratio. Total asset to debt ratio formula. Long-term debt. What is the value for total asset and long-term debt? Total asset is 7 lakhs. Divided by long-term debt is 1.5. So 7 divided by 1.5 is equal to 4.67:1. Then proprietary ratio. Look at this proprietary ratio. What's the formula for proprietary ratio? Shareholder fund divided by capital employed. Shareholder fund how much? 5 lakhs. Capital employed. Capital employed is capital employed means what? Long-term borrowings plus shareholders fund. So answer is 0.7:1. Shareholder fund is 5 lakhs, just now we told, divided by capital employed. Capital employed is 5 plus 1.5, 6.5. In this question, this author has taken this 50 also. See, listen one minute carefully. There are some area in which the opinion differs from one author to another author. The question, the logic is we are comparing the total capital employed with total, what's the formula? Capital employed. Okay. Sometime what happens, the total capital employed is only long-term borrowings plus shareholder fund. Some author is thinking current liability is also fund employed in the business. That's why he has taken like that. Okay. Don't worry, you take only whatever we have done in the first equation. So how much will be the answer now? What's the value now? Which ratio you're calculating? You're calculating proprietary ratio, no? So shareholder fund, what's the formula we have taken? Shareholder fund divided by capital employed. Capital employed is equal to long-term borrowings plus shareholder fund. Okay, in that way, 5 lakhs divided by 6.5 lakhs. Okay, 5 lakhs divided by 6.5 lakhs. Answer is equal to 0.676. 0.76:1. That's fine. Okay. Why that difference is there means he has taken the total asset. Capital employed should be equal to total asset. In that logic, he has taken because current assets have been considered as capital employed. All liabilities will result in some asset. That's the basic logic of accounting. All assets will result in liability. Liability will result in asset. But current assets are made out of current liabilities. Normally, okay, some company may create current asset out of long-term liability. That is wrong. Mismanagement of cash. That's not a good financial management. I have to create a building by borrowing long-term funds. If I create a building by taking an overdraft facility, within another 3 months I have to pay off. Then where from I will pay? So that logic. Okay. Next, we'll take one more, then we can finish it. That is debt to capital employed ratio. Debt to capital employed. What's the debt? Long-term debt already we have. That is 1.5 lakhs. Capital employed we already have. That is 6.5 lakhs. So 1.5 divided by 6.5 is equal to 0.23:1. What is the meaning of this 0.23:1? Out of 1 rupee of the total capital employed in this company, 23 paisa is made out of borrowings. Borrowings. Okay. So you can have at least 1:1. 1 rupee you can make an asset out of 1 rupee of borrowings. That's okay. More than that, if it is there, then your company is having some kind of mismatch of your assets and liabilities. Your company is not having solvency position good. Okay. So these are all the various ratios under solvency. Solvency ratios. Okay. Solvency ratios. Any doubt in this? Liquidity ratio and the solvency ratio. These two are talking about the financial position of the company. The other two, what we are going to talk about, that is efficiency and profitability. That all comes under the category of performance of the company. These two are analyzing the financial position of the company. The two, what we are going to discuss after the break, is analyzing the financial performance of the company. Okay, one of your student is asking a doubt. Yes, sir. Yeah, no. We are simplifying it. Actually, instead of telling the absolute figure, we are talking out of 1 rupee. So the comparison is easy. Out of 1 rupee of my total asset, see, you may see a budget, no? After the finance minister is presenting a budget, a small pie diagram will be given to you. How 1 rupee of revenue is distributed to various sectors. So it is easy to understand. Suppose I am telling, to defense, I have spent 25,000 crore in this budget. You may think it's a big amount. But out of the total revenue, what is the 25,000 crore? If you think, that is easy for comparison. For that purpose only, it is finally coming as decimal. It's called number of times. 1 time of liability and how many times of asset. 1 time of capital employed, how many times of asset. 1 time of loan, how many times of asset. So it's only for easy reference, easy comparison. Only that reason. Otherwise, this itself is serving a purpose. Look at this. This itself is serving a purpose. 5 lakhs by 15 lakhs. 5 lakhs of debt. I am using 15 lakhs of equity. That's little uncomfortable if I compare with another company. Suppose another company is there. My competitor company is there. It is having 7 lakh of debt and 16 lakh of equity. Now, 5 lakh by 15 lakhs, 7 lakh by 16 lakh should be brought down into a small number. Then only the comparison is easy. For that purpose only. Okay, easy understanding and easy comparison. Okay, with this we can stop now. We can break for 10 minutes. Then we can reassemble. Thank you. Those are online. It's a break for 10 minutes. You can take a break and come back. So one small request to those who are particular about referring the recorded video or audio. It's a normal class. We are not doing it for recording. So you can refer recording, no problem, but don't compare that recording or recorded classes with the recorded videos what you see in the YouTube or in some academies. That's professionally taken only for recording. I have to stand like this or sit like this. I have to talk for 40 minutes or 30 minutes. That is different. And this is going in a flow. So that you have to keep in mind and you have to refer this, view to this or listen to these videos later. If you are really listening to the videos later. Okay, that point you keep in mind. All right. So next, third group of ratios, third family of ratios is profitability ratios. Profitability. Okay. One more ratio in the solvency ratios, that is interest coverage ratio. Before we go to the next group, interest coverage ratio. What is this interest coverage ratio? Helps us means it is checking the relationship between the earnings and the amount of interest to be paid. How much the earning is going only for payment of interest. That relationship is being tested here. Look at this formula. Net profit before interest and tax divided by interest on long-term debts. That line is missing over there. Okay, it's divided by net profit before interest and tax. Before interest and tax divided by interest on long-term debts. Say for example, my company has earned 10,000 rupees as net profit before interest and tax, and my company has to pay 5,000 rupees as interest to the borrowings. Meaning 10,000 divided by 5,000. Answer is going to be 10,000 divided by 5,000 is equal to 10,000 divided by 5,000 is equal to, please tell me. 2. Actually 2. So one time is at the denominator. So 2:1. Meaning 2 times of my earnings are covering my 1 times of compulsory payment of interest. Okay, it can be up to the maximum of 1:1. If it is less, suppose I'm earning only 4,000. My interest payable is 5,000. So 4,000 divided by 5,000. What's the answer? 4 by 5 is equal to 4 by 5. 4,000 is the earnings, net profit before interest and tax. 5,000 is the interest payable on the long-term loans. Sorry? There is no doubt. Only calculator if you put it will come. Sorry? Point 4,000 divided by 5,000. 4 by 5 is equal to 0.8:1. Meaning 80 paisa is available roughly to pay off the interest of 1 rupee. If that is continuing, I have to pay interest out of capital. Slowly capital will be eroded. Okay, you cannot pay interest by borrowing further loan, or you cannot pay interest out of the capital, or you cannot pay interest by selling some asset. All these 3 things are normally harming the company. No need of accounting to be understood for this reason, for this purpose. It's simple logic. If I borrow money, I have to use that money to generate something. From the generated amount, I have to pay off the interest, and I have to save some amount out of generation, out of every year amount generated, so that I can pay off the loan in the end of the loan period. So that is normal thing required. If you are not doing that, if you are not in a position, then your company is going to be insolvency slowly going to insolvent. So that is being analyzed here. Interest coverage ratio is equal to net profit before interest and tax. Where you can find this net profit before interest and tax? You can't find out in the income statement directly this value, because in income statement, sales plus other income is equal to total revenue minus all the expenses, including finance cost. It's equal to net profit minus tax, net profit after tax. That is the flow. So how do you find out this value? Net profit before interest and tax. You have to take your net profit after tax plus interest. That gives you the net profit before interest and tax divided by only interest. Where you can find interest? In note number, you can find the interest. Under the finance cost note number, if you refer in the P&L account, finance cost will be there. Finance cost will have one note number. That note number you have to check in the working note. That note number will talk about the amount of interest payable on long-term debts. Okay, so that relationship you have to find it out. Okay, any doubt up to these 2 family of ratios? Okay. Next, we are coming to the third aspect, that is efficiency ratio or turnover ratio, or you can call it as activity ratio. Efficiency, turnover, or activity. So these ratios are helping us in order to find out how effectively the company is being run. First one is inventory turnover ratio. What is inventory turnover ratio? It relates to the marketing department of the company. Marketing efficiency of the company is being tested here. What is inventory? Stock. What is turnover? Sorry? Conversion. Okay. Stock converted into sales. Turnover actually refers to sales. So stock turnover ratio is testing the relationship or establishing the relationship between turnover and the stock. So our formula is inventory turnover ratio is equal to cost of revenue from operation, meaning cost of goods sold, or simply sales. If you have sales, you take sales there. So if we have cost of goods sold, you can take cost of goods sold. What is cost of goods sold? Sales minus profit. Cost of goods sold is nothing but sales minus profit. You are having a data for sales. No profit data, no cost of goods sold data is there, then directly take sales. No problem. Suppose 5 rupee is the sales, 1 rupee is the profit. What is the cost of goods sold? Selling price 5 rupee. Profit on the sales is 1 rupee. What's the cost of sales? Cost of goods sold? 4 rupee. Okay. If you take 4 by something or 5 by something, answer is going to be slightly different. If I don't have data about profit and cost of goods sold, I can't substitute cost of goods sold as a numerator. So I can take directly sales. Sales is an open figure. Sales is available in the public domain. In the profit and loss account, the first line is sales, revenue from operation. You take that. If profit is there, minus profit from revenue from operation, you will get a concept of cost of revenue from operation. Okay. Right. So inventory turnover ratio is nothing but the relationship between sales and inventory. Inventory means average inventory. What is average inventory? Every day inventory value will change. Purchase is there, sales is there, so every day it will change. So we take average inventory. Opening stock plus closing stock divided by 2 is equal to average inventory. Okay. So if you take this, that is called inventory turnover ratio. I'll give a simple example. Look at this. Inventory turnover ratio. 60,000 divided by 20,000. What is 60? 60,000 is the cost of revenue from operation or sales divided by 20,000. Answer is equal to 3 times. So what is the standard or how do we interpret this number? Calculation is simple. You know the formula, you know data, you're taking it, you're putting in calculator, you're getting answer. So how do you interpret this answer 3? What is this 3? 3 times of inventory turnover ratio. 3 times is the inventory turnover ratio. How do you interpret this? Anybody? What is the significance of this number 3? Suppose another company or last year my company same inventory turnover ratio is 4 times. This year it is 3 times. What is your interpretation? Interpretation is important in ratio analysis. Reading is done by machine, blood pressure or anything done by a machine. Lab will give you the result. But doctors should analyze that result and give some interpretation. You are a doctor now. What is interpretation now? Sorry? Inventory is the 1/3 of the turnover. That's one way of interpreting. Other side? The sale is good. How, madam? Sale is good. Suppose another company's sales turnover ratio, inventory turnover ratio is 4 times. Another company is having 5 times. That is best, better, much better. Okay. So she found out the adjective, much better. Okay. 6 times. Yeah, in English you can go like that. Okay. So what is the basic understanding? Sir told something, you know, the 3 times, or he told 1 time. 1 time is the stock of turnover. Other side of it, the other way of telling, same thing, other way of telling it is, my stock is turning over only 3 times in a year as sales. My stock becoming sales 3 times. Okay. So number of times increasing is good for the company, efficiency of the company. How quickly your stock is converted into sales. So marketing department functions very correctly or very efficiently. Salesman is doing their job very efficiently. Yes, sir. Sorry. This 3 times with anything. Yes, we can. It's a very basic understanding, 3 times. Okay, my stock is turning over into stock sales as 3 times. Okay, if it is low, suppose my competitor company is having 4 times. 15,000 is the stock, but they are able to manage 60,000 of sales. Another company, only 10,000 stock they are keeping, but they are able to manage 60,000 worth of sales in a year. So they are best 6 times. This is only basic understanding of comparing. He is asking why that 3 times is for me. That's what comparing that with another variable. What is the sales policy of company B, which is having a sales turnover ratio of 4 times? I mean, stock turnover ratio of 4 times. Another company, what is their sales policy? 6 times they're having stock turnover ratio. Is there any policy change, policy differences between these 3 companies? I can learn. So I am comparing with credit sales. They're having credit sales policy. My company is having only cash and carry. No, available, that's altogether a different concept. Now, after this becoming a stock, how much it's quickly transferring into sales. That is called conversion period of raw material to stock. That is different issue. Now we are discussing about after it becomes a stock, after it becoming a merchandisable goods, how quickly it is converted. So sales department, how it is constituted, sales policy, your credit policy, your collection policy, your demand for your product in the market, all those things need to be analyzed. That's altogether a bigger project. So it's giving you the insight first what you are. So my stock turnover is only 3 times. Same level of company, same product, they are having 4 times. Or I had 4 times last year. This year it has come down to 3 times. What is the problem? I have to connect this with so many other concepts. Okay. Next. So what is the standard here? What's the deciding rule? How do I interpret this number? Higher the number of times of inventory turnover ratio, better the
efficiency of the organization. So this going to vary that that organization to organization. So for example, there's a manufacturing industries because of the lead time is more.
Hold on. You are telling it varies. What do you mean by that it?
This inventory because of industry, that's going to vary industry manufacturing industry to industry. So for example, manufacturing industries because of the long lead items. So that may required we need to keep the inventory. And also I just interpret that this is a competence of SCM department. Again, I'm jumping into SCM department because if he's just smart enough, that SCM guy is smart enough, we'll ask to suppliers saying that you keep ready the material. So once I need it, once I start manufacturing, I will take it. That is the competence of again that SCM. So this is going to vary from organization to organization, and then competence of SCM department.
Gentlemen, I have 2 questions to you. You are telling it. What is it is varying? Okay, I understand English, but I don't understand that third person singular it. What do you mean by it here? It refers to the number of times 3, or you are referring to someone else, something else?
Here I'm something else. That's industries. Industries.
What is that it? If it is not known to me, what is it?
Sir, it means I'm telling that this is the manufacturing industry, something like a trading industry.
I'm not talking about what number is good, what number is bad. I'm telling better, higher the number, better the efficiency. Okay, if I say 4 is standard, less than 4 is not good. If I say, then your the dialogues holding good, meaning that there are some companies lead time is more. Suppose a cracker industry, cracker business, fireworks industry. They produce throughout the year, but sales takes place few months. True. Okay, umbrella industry, umbrella companies. Okay, there are some companies, seasonal demand, production is throughout the year. That time definitely lead period is going to be long. Okay, they can't have a shorter inventory turnover ratio. They will definitely have longer period. But among them, suppose A, B, C, D, F, all these companies are same industry. My point is, higher the number of times of inventory turnover ratio, better the performance. Among those companies in the same industry, which company is able to convert their stock quickly? All the companies may be having more than 10. I'm sorry, all the companies may be having less than 2. Less than 2. Within 1 to 2, 1 to 2, there are so many numbers, no? 1.1, 1.2, 1.3. Suppose your company is having 1.7 times of inventory turnover ratio. Other company is having 1.5 times. Definitely the lead time is more. That's why you are not able to convert your stock into turnover quickly, because demand is only for less months, limited number of months. So among your competitors, how quickly you are able to convert? That's one thing. Another my question is, what is that SEM you're telling? Some. Okay, because we academicians may not be knowing all those your terms. Supply chain, SEM is telling supply chain management. So regarding that, what is asking? Regarding that, what you are asking?
No,
SEM.
see, if in this, so for example, manufacturing industries, something lead time is more. The SCM department is not enough, and then this competence enough, they will negotiate with the suppliers. And then we don't want to keep that inventory in our house, because we will ask suppliers and then keep that inventory. But when, as and when we required, and then we will take it and then, take that material in.
Just
So
hold
that
on.
I will take care.
One second. Hold on there. If you do all these things, are all negotiations. All those things cannot be captured in the books of accounts. When you receive, when you agree, when you sign a contract, that time only it is coming to books of accounts. When you tell them not to supply to you right now, not to give your inventory today to you, that no matter for us, accountant will not reflect in the books of accounts. Okay. After all these things, you are affecting all the transactions. That will be reflecting in the books of accounts. For that, what is the inventory turnover ratio? We are talking about something which is outside the books of accounts. Based on all those negotiations only, you are going to enter into your transaction. After you enter into a transaction, how much is your inventory? So that only is captured here in the balance sheet. From the balance sheet only we are referring the data. So all those things will be automatically taken care. With all these managerial techniques, all these managerial capabilities, your bargaining power, you are dictating to the supplier, or you are just submissive to the supplier, all those things put together, it is reflecting in the balance sheet. After that, we are analyzing it. In the analysis, we are coming to know what is your efficiency. We are telling you are efficient or not efficient. For that, you have to take corrective actions. If you are efficient, you feel happy, and you have to try to improve your efficiency further. See, one thing you have to understand. One side, if it's efficiency, means another side something is missing. I'm telling you, I'm going with little fast, means I can cover up the syllabus quickly. But what is the other part of it? The understanding capacity of the student may not be in the same pace. So everything is having its own other side of it. If I say efficiency, suppose the company is having huge amount of profit, 80% is the profitability, 80% is the GP ratio, gross profit ratio. What does it mean? You will simply say the company is abnormal. The company is having lot of profitability. Good, sir. You will say this is one side of it. Another side of it, or another side of it. Huh? Something is wrong. What is that wrong? What is the other aspect of a company is having profitability of 80%? The customers are exploited. Don't you think so? As an investor, you are happy. 80% I'm earning. Out of 100 rupees sales, 80% is profit. Only 20 rupees I'm spending for cost of sales. 80% I'm getting profit. Good. One side of it, efficiency, profitability. But other side of it, social costs, social problems. Customers are exploited. You are having monopoly power in the market. It's an indication to the government of India to dilute that industry. Hello? Simple logic, simple mathematics. 20 plus 80 is equal to 100. That's a mathematics. Now you are going away from my discussion. I told only 3 figures: 80, 20, 100. 100 is the sale price, 20 is the cost price, 80 is the profit. Yeah, the company, no, I'm not telling 80% of the companies are doing profit. I'm telling in your company, you are having a profit of 80 rupees out of each and every 100 rupees sold. No, I'm not telling something is going wrong. I'm telling something is good for the company, but the other part of it, other effect of it is affecting the society. Suppose you as a customer of that particular company, you are exploited. How? You are not accepting that you are exploited? Cost is only 20%. I'm making one product that costing me only 20. But I'm telling you, buy it for 100. Don't you think that you are exploited? Definitely you are exploited. If you're a monopoly, it's possible. Maybe random, I mean, hypothetically, I'm talking about. But it is true. It's possible. Chances are there. So, gentlemen who are asking that question, we are capturing everything together in the balance sheet. After that, only we are analyzing it. So, all your supply chain management concept or your negotiations, whatever you do, or the nature of industry, everything is being captured in the balance sheet. Balance sheet is giving the data, we are analyzing that. So, if we have more number of times, simply a logic is number of times are more than inventory turnover ratio is giving a number of times more, the company is said to be efficient. For example, take this 60 by 10. What's the answer? 6. What's the logic on that? With the help of 10,000 rupees as an average stock at any given point in time in a particular year, the company is able to manage the sales of 6,000 in the year. Another companies are 6,000 only is the stock, average stock. They're able to manage 60,000 rupees worth of sales in a year. So the ratio is 10 times. How this is possible? Only because of all your SCM management, all your other part of the marketing team, credit policy of the company, everything is put together. So now all those points that gentleman was telling, that is helpful for us. If you are not having a good number here, if you are not having a good position here, you have to rework on all those facts, all those factors. Okay, sir, am I making sense? Is it clear to you, or are you convinced?
Very clear, sir. So,
Yes.
thank you very much, sir.
Thank you. So next one, we'll come back to the next. Good, actually. The trade receivable turnover ratio. Same thing. Instead of stock, we are going with turnover. I mean, receivables. Receivable turnover ratio. How you are good in managing your collections? How good you are managing your receivables? That is being captured in this ratio called trade receivable ratio. Trade receivable ratio. What is trade receivables? The amount receivable from the customers. Okay. So trade receivable turnover ratio is equal to net credit sales divided by average trade receivable. Net credit sales. Net credit sales divided by average trade receivables. What is net credit sales? Total credit sales or total sales minus cash sales minus sales return is equal to net credit sales. Net credit sales is nothing but total sales minus cash sales minus sales return is equal to net credit sales divided by average trade receivable. What is average trade receivable? Opening trade receivable plus closing trade receivable. Last year balance sheet, how much trade receivable is there? Current year balance sheet, what is the trade receivable is there? Put together total divided by 2 is equal to average trade receivable. What is trade receivable? Bills receivable, accounts receivable, debtors, all the things put together. Here we include everything. Trade receivable, book debts, okay, are simply debtors, accounts receivable, everything put together. Okay. Suppose you are getting an answer like this. Trade receivable ratio is equal to 4 times. So you know the logic? You will calculate, no problem. I'm not telling you to calculate something right now. You can practice later. Now we have to understand how do we interpret this number. Trade receivable turnover ratio is equal to 4 times. What is the interpretation here? What is understanding? If you don't understand from 4 times, go back to the data. What's the data? 3.2 lakhs divided by 80,000. What is 3.2 lakhs? Turnover. Credit turnover. Divided by average. Average, it's not average inventory, they have written wrongly. Average receivables. Average receivables. Okay. That is 80,000. So that is equal to 4 times. Mathematically, okay. What is the interpretation for this? Suppose you take another example. Another company 3,20,000 sales is there, turnover, credit turnover is there. That company's average receivable is 3.2 lakhs. Denominator and numerator both are same. Answer is equal to 1 time. Suppose another company, 3,20,000 divided by 1,60,000. What is their answer? 320 divided by 160. 2 times. Now you tell me which company is doing better. One is 2 times, another one is 4 times, another one is 1 time. 1 time? Is it better? Okay, I'll give you another example to understand a little more better. Go here. We have another formula. This is called trade turnover, trade receivable or average collection period. This is called average collection period. Okay, keep these 3 numbers now. 1. What's the answer we have? 1 to 4. 1 to 4 we got. Right. Now take a first company. Number of days in a year, 365 divided by 1. What's the answer? 365. What is 365? Average collection period. Number of days required to collect the debt is equal to 365. Take the second company. What's the answer for average? What's the answer for receivable turnover ratio? 2. 320 divided by 160 is equal to 2. 2 is the number of times of receivable turnover ratio. Now bring that 2 into this formula. What is this formula? This formula is going to give me the average number of days required for collecting my money, debts from the debtors, okay, from the customers. Now 365 divided by 2 is equal to 182.5. Now original answer. This book answer is how much? 3 for 4. 4 times were there, no? Take 365 by 4. 90 days, approximately 90 days. So which is good now. How quickly I am collecting. In the fourth case, only within 90 days, I am able to collect my debt. So higher the number of times of receivable turnover ratio, better the efficiency of the collecting capacity of the company. So this formula also you have to keep in mind. Number of months in a year divided by receivables turnover ratio will give me average collection period. What is average collection period? As an average, within how many days my debt, my sales is converting into cash. Okay, how quickly it is converting into cash. Okay, I repeat again. Receivable turnover ratio is equal to net credit sales divided by average receivables. Average receivable is nothing but opening receivable plus closing receivable by 2. Receivable includes here sundry debtors, book debts, or simply debtors, bills receivable, accounts receivable, all put together. Okay. If we get some number, that number can be divided, that number can be used as a denominator from the total number of days or from the total number of months in a year. 12 by the answer, or 365 by the receivable turnover ratio. That gives you the number of days or number of months within which, as an average, you are collecting back your sales made on credit basis. Okay, that's called average collection period. Next, trade payable turnover ratio, just opposite. Now we analyze the receiving capacity of you. Now we are going to analyze the paying capacity. Okay, there's a basic concept in finance. You'll study the next semester. Delay your payment, urge your receipt. Are you understanding? Delay your payment. Suppose university is asking the fees, you have to pay at the. If there is a cash prize given by the university for your achievement, you have to be standing first. Okay, I did not tell the first one. I just left it. Okay, so you have to take a call. Okay, right. So that's simple example, colloquial example I'm telling you. So that's a basic, those days, traditional way of financial management. Delay your payment, urge your receipt. If anybody is to give money, you have to make 24 hours call. If anybody has to collect money from you, you have to go in a flight mode always when he is calling. So that kind of the things they have made long back. Oh, traditional way of financial management. Today we have a lot of technique. Okay, we can't go by. If you delay payment, the next time they won't entertain you for the further trade businesses, trade activities. Okay. So how you are good in paying? I mean, how not good? How quickly you are paying? That's what being captured in this particular ratio called turnover. Sorry, turnover to payables, payable turnover ratios. Look at this equation. Credit, same logic. Net credit purchase, because payable comes because of purchase. So net credit purchase divided by average trade payables. So what is net credit purchase? From the income statement, from the P&L account, you find out what is the purchase minus the cash purchase minus the purchase return. You will get net credit purchase. Okay, divided by average trade payable. Same logic. Opening trade payable plus closing trade payable divided by 2. What is opening? Last year balance sheet. What is there? That's called opening for the current year. Current year balance sheet. What is there in the balance sheet of this average trade payables? Creditors, sundry creditors, bills payable, accounts payable, etc. Put together. Okay. Similar logic. Payment period. Average payment period is equal to number of days in a year divided by trade payables turnover ratio, number of times. Okay. If you take in month 12 by this ratio, it will give you answer in month. If you take 365 by this ratio, it will give answer in number of days. Okay, lesser the number of days is good that you are paying within the time. But from our point of view, higher the payment period, average payment period, better the efficiency of the company. Because you are managing your creditor for the late payment. Late payment means not with due fine and not with any penalties. The term credit itself is allowing you to enjoy more credit period. If you are able to do that, you are good in managing your meaning. 3 months credit you are getting from your supplier, 2 months credit you are giving to your customer. So you are able to manage it. Okay, that efficiency is coming. Next, you will study this little further or in elaborate manner in financial management or corporate finance later. It's outcome of corporate finance. Some gentleman was asking, so many negotiation, SCM, all those things. This is also like that. All practices of your financial management is resulting in accounting transactions. That accounting transaction is resulting in the data in the P&L account and balance sheet. That we are analyzing. Then again, we can go back. Whether it is correct or not, we can check it. Yes,
Professor, very sorry for
no
interrupting
problem,
you. Kindly accept my apologies. And then I'm Riaz here. See,
Yes,
so
yes.
for example, my customer is asking that, normally we have that credit about 30 days, so for the customer. So customer is stressing me and then he will ask about 90 days. But by great difficulties will agree. But, I will ensure that, suppose for example, 90 days, that financial charges, I will take 90 days, I will put it in my FMR. But I will not inform to customer. Indirectly, I will ensure that 90 days credit period, what's supposed to get that financial charges, I will put it in my FMR. I will take care. So this way, at the end, the customer also has to pay for that. That product cost will increase on that. So this is very sensitive matter that definitely, I will come and discuss with you offline. Because since I'm online, so we will discuss.
We can discuss offline, no issues. But now, time being, I would like to make myself understood. I just repeated what you asked. Suppose there is a customer, he was sold goods for 60 days credit period.
So, for example, 30 days, yes.
Okay, 30 days.
Professor. Yeah.
He is going to pay me only after 60 days.
90 days. So, for example, 90 days.
Okay, his credit period is 30 days.
Yes, sir.
But he is paying only after.
He's not going to pay, Professor. He will negotiate with me. He will negotiate with me instead of 30 days. He will negotiate with me for 90 days. But for me, what's supposed to deliver the product, so for the price, I will add that another 2 months. That is the financial charges for 90 days. For another 60 days. What is the financial charges or interest charges?
Okay.
I will add in this. I will give as a product
You will
price.
add in what? You will add in what?
90 days, that is the interest charges.
So you'll be telling to your customer.
I will not tell, sir. I will not tell, Professor.
Then how do you add it? How do you add it?
I will ensure that the smart way. I will ensure
What
that.
is that smart way? We want to know. How do you charge that? Suppose you are having a extra expense of 1,000 rupees because of his delayed payment of 60 days. You are supposed to spend another 1,000 rupees as a finance cost, as an interest. How are you going to collect it from the customer? You are telling smart way, accepted. But how are you going to charge from the customer?
What he is saying is he would include that into his product charge itself.
That's it. Whoever your answer is there only, that sales comes under
Yeah.
P&L account. What we have taken as a numerator in the previous formula, what we have taken as a numerator? Net credit sales. So sales value already captured that amount of interest. You are telling smart way. That smart way is increasing the price. It's simple. It's not just like hidden charge. It's already known to everybody. We may think that it is not charged separately, but if I'm going to take a bike on finance basis, customer, okay, Pulsar price maybe 1,40,000. If I go for EMI, definitely it is going. Of course, it's a known way of taking it. Okay, maybe 1,75,000. Okay, similarly, same thing. What he is telling, the bike I'm taking it delivery today on cash, maybe 1,40,000. I'm asking credit period of 3 months. I'm not going for EMI. I'm going for credit period of 3 months. I will pay you after 3 months 1,47,000. I'm telling no, sir. Credit means not 1,47,000. Credit means 1,60,000. You are having a credit period of 3 months, 90 days period. You can come and pay the money of 1,60,000. That 1,60,000 is a selling price. So the selling price already captured in the total sales minus cash sales. Remaining is credit sales minus net. Sales return is equal to net credit sales. That's already captured. So what is your question now? It's already captured in the selling price of the product. As your friend is supporting you and telling, decoding that fact. If it is not your doubt, you can ask me again. That secret way or smart way of telling, that smart way your friend is decoding as selling price will be inflated. Selling price will be hiked. True. That's the only possible way that I know. If any other way you are charging your customer in a smart manner, you can tell us, we can discuss. It's good that you are connecting in your real life what you are doing with this discussion, what we are having here. That's good. Yes, gentlemen, any other addition you want to say for that smart way or something secret way of doing it?
No, Professor. We are very clear. And then I like to come over there.
Good. We come and discuss.
I will love come and meet you, Professor.
Sure,
We'll discuss
definitely.
offline.
We'll do that.
Thank you. Thank you,
Yeah.
Professor.
Good. See, all your possible thinking, everything is captured in that formula. Because you may think that's why everything you are telling captured in the formula. It's not a smart way of answering your question. That's the real concept. Because we are doing a post-mortem analysis. Next year, you will be taking this into the practice and you will alter the practice of yours in the next year. Suppose your credit turnover ratio is not in favor of you. Trade receivables ratio is not in your favor. You will alter your credit policy. Simple logic, mathematics. See, numerator and denominator is there. 5 by 2 is equal to 2.5. If I want to increase that, what I must do? 5 divided by 4 is going to be 1.25. How do I? Simple mathematics, but doing that is in practice. How it is possible? What is that 5? Credit sales. What is that 4? Average trade receivables. How can I increase the average trade receivables? How can I increase? Average trade receivables, how can I increase? I'll give more time for my customer to repay. That's it. In that way, I can increase my sales. So every points are interconnected, but this is a post-mortem analysis. Based on this, we're going to take a decision in the next year. This is nothing but the result of the decision what you've taken in the last year. Next is this text is available in the LMS. You can download today and you can go through all these numbers. Okay. Net asset. Sorry, what is the next one? Yeah. Net asset capital employed turnover ratio. Net asset to inventory turnover we studied. Payable turnover we studied. Receivable turnover we studied. Now fourth one. Net asset is being compared with the sales turnover. What's the relationship between capital employed or net asset to sales to turnover? Okay, so the formula is sales divided by capital employed. Revenue from operation means sales. Sales divided by capital employed. This is a formula to calculate net asset to turnover ratio. Suppose capital employed is 1 lakh and revenue from operation is 50,000. So what's the answer for now? Capital employed is 1 lakh and revenue from operation is 5 lakhs. Take an example, another example. 5 divided by 1. Answer is equal to 5. Another company, take an example. That company is having a sales of 7 lakh, having a capital employed of 1 lakh. What's the answer for them? 7. Which company is better now? One company is having sales of only 5 lakhs for the investment made in the company of 1 lakh. Another company is having same 1 lakh investment, but their sales is 7 lakh. Which company is good? Second company is good. So higher the net asset to turnover ratio, better the efficiency of the company. With the help of 1 lakh, how much I am able to sell? Next, fixed asset turnover ratio. Fixed asset, under this we have sub classification. Okay, fixed asset turn. This is net asset means all the assets put together. Here it is only fixed asset. Fixed asset to turnover ratio is equal to sales divided by fixed asset. What is net fixed asset? Fixed asset minus depreciation. Okay. Here also same logic. Higher the ratio, better the efficiency. I have 2 lakh as fixed asset and I'm earning 10 lakh as my sales, not profit, sales. 2 lakh is the fixed asset, 10 lakh is the sales. What is the ratio now? 5 times. Another company, 20 lakhs is the sales, 2 lakh is the asset. What is their ratio? 10 times. So that company is more efficient than this company. Working capital to turnover ratio. Working capital, same logic. What is my sales for each and every 1 rupee of working capital invested in the company? What is working capital? Current asset minus current liability is called net working capital. Total of current asset is called as gross working capital. Okay. So for each and every 1 rupee of working capital invested in the company, what is the sales the company is able to achieve? That is being measured in working capital turnover ratio. The formula is sales divided by working capital. Okay. This is also same logic. Higher the ratio, higher the number of times, better the efficiency of the company. So this question you can work it out later. This question is having data, the balance sheet, and you can calculate net asset turnover ratio, fixed asset turnover ratio, working capital turnover ratio. Yeah. The last category is profitability ratios. Profitability ratios. The ability of earning profit by each and every 1 rupee of sales, by each and every 1 rupee of investment is being measured in this ratio called profitability ratios. Okay. The financial performance actually is measured in this category only. How the company has performed as overall in terms of profit. What is the earning capacity of the company? For every 1 rupee invested, how much I'm getting as a return? Okay. So it's a group of ratios. It is trying to fix the relationship or find out the relationship between the profit and other factors, other accounting data. Okay. First one is gross profit ratio. What is gross profit? Anybody? We have not come across this concept in our class so far. Gross profit. In the profit and loss account, we don't have any breakup called gross profit. Sorry? Excluding? That is profit before tax. EBT, earnings before tax. We don't have this logic in the P&L account. What we prepare according to Companies Act, gross profit need not to be revealed separately. Need not to be revealed. In the format, it is not there. But actually, accounting term is gross profit. What is gross profit? Sales minus cost of goods sold is called gross profit. So what is cost of goods sold? Cost of goods sold is nothing but opening stock plus purchase plus expense on purchase minus purchase return plus expense on sales, all direct expenses. All these put together, we call it as cost of goods sold. Opening stock plus purchases plus purchase related expenses minus purchase return plus any expenses on sales minus closing stock. Minus closing stock. This is equal to cost of goods sold. Suppose I have bought 1 lakh worth of goods by spending 10,000 rupees on transport. I sold all the goods. What is my cost of goods sold today? 1 lakh 10,000. That's it, simple. But before buying 1 lakh worth of goods, I already had some 15,000 worth of goods. I sold all the goods, whatever I had and whatever I bought. Now, what is my cost of goods sold? 1,25,000. Okay, same example, second example. I sold all the goods except 5,000 worth of goods. 1 lakh, 1 lakh. The 5,000 will be minus, that's all. Closing stocks will be minus. So this is the logic of calculating the cost of goods sold. Cost of goods sold. If you minus the cost of goods sold from sales, you will get gross profit. Okay, come to the first ratio, gross profit ratio. Gross profit ratio is nothing but gross profit divided by net sales multiplied by 100. Cost of, gross profit divided by net sales. Net sales means sales minus sales return. Whole thing multiplied by 100. So these ratios are expressed in terms of percentages. Higher the percentage of GP ratio, better the efficiency of the company, better the performance of the company. Okay. Next one, net profit ratio. Okay, before that, operating ratio. Operating ratio. Operating ratio. What is operating ratio? The formula for operating. What is operation, first of all? What do you mean by operating here? The core business activity is called operating. Okay. So operating ratio is equal to operating cost divided by net sales into 100. What is operating cost? Cost of goods sold plus operating expenses. Or simply you can say the purchase plus operating expenses divided by net profit, net sales into 100. Operating ratio is equal to operating cost plus the cost of goods sold divided by net sales into 100. It tells the percentage of total cost what is incurred on sales. Suppose I am selling goods for 100 rupees. Out of 100 rupees, what is my cost? Suppose 80 rupees is my cost, means operating ratio is equal to 80%. Operating ratio is capturing the percentage of cost of sales out of 100. Okay, now tell me what is the interpretation? Suppose one company's operating ratio is 80%, another company's operating ratio is 70%. Which company is good? 70%. Lesser the operating ratio, better the performance of the company, better the efficiency of the company. Next. Operating profit ratio. It is very simple. Now you can tell me what is the formula for calculating operating profit ratio? 100 minus operating ratio. So 20%, my example, 20% for one company, 30% for another company are the answer of operating profit ratio. Simple. Operating profit divided by net sales into 100, one way of doing it. Otherwise, simple way, if you already have operating ratio, minus that from the 100. 100 minus operating ratio is equal to operating profit ratio. Otherwise, another way of doing it is operating profit divided by net sales into 100. Both are giving same answer. Okay, next one is net profit ratio. Net profit after tax divided by net sales into 100. We are comparing the last bottom line of the P&L account with the sales. For every 1 rupee of sales or every 100 rupees of sales, what is my net profit? Net means what? Everything is paid off. That amount is available to whom? Shareholder or the owner. Okay, everything is done. That is the residual amount. Bottom line of the profit and loss account. Okay, so net profit divided by profit after tax. Sorry, net profit after tax divided by net sales. Net sales into 100. You are comparing the net profit after tax with the net sales. Net sales means total sales minus sales return. Here total sales means both cash sales and just sales. Just sales. There is no cash and credit we are dividing. Okay, only for receivable and payable we do that. Next, return on capital employed, ROCE. Return on capital employed, ROCE. You might be seeing in the newspaper or in the CNN news channel, all this NTTV profit, they will talk about this. Okay, so ROCE, return on capital employed, or ROI, return on investment. How do you calculate? Simple equation, return upon investment. Return upon investment is equal to return on investment. Okay, how do you calculate? Return upon investment. What is return? Profit before interest and tax. Profit before interest and tax divided by capital employed. Investment is nothing but capital employed. Whole thing multiplied by 100. What's the logic? Higher the ratio, higher the ROI percentage, better the efficiency of the company. We are going more specific now. First, we had total asset, total capital employed. What is total capital employed? In the previous formula, ROI. What was the denominator? Investment or capital employed. What is capital employed? How do you calculate capital employed? Shareholder fund plus long-term debt. We discussed already. Okay, in solvency ratios. We are going little more, narrower. Capital employed is product term. Here it is only shareholder fund. Numerator remains the same. So the profit after tax divided by shareholders fund multiplied by 100 is equal to return on shareholders fund. Suppose you want to calculate only return on equity shareholder fund, that time return on equity shareholder fund. That time profit after tax divided by only equity shareholder fund, resource and surplus plus equity capital. We should exclude the preference capital. Shareholder fund includes preference capital also. Okay, this is very, very important concept, that is earning per share. Earning per share. What do you mean by earning per share? If I am a shareholder of this company, how much I am eligible to get as an earning from this company for each and every one share that I have in this company? How do you calculate? Profit after tax minus preference dividend is equal to profit available for equity shareholders. Last line is profit after tax. Suppose 1 lakh is there. From the 1 lakh, you have to minus the dividend payable to preference shareholders. If your company has preference shareholder, you have to minus. Otherwise, no need. That will be 0. So 1 lakh remains the same. So formula is earning per share is equal to profit, net profit available to equity shareholders divided by number of equity shares in the company. Okay, look at this. Number of equity shares in the company. Profit after tax minus dividend payable for preference shareholders, that need to be divided by number of equity shares. Is it understandable? What is the logic? What is the interpretation? Suppose I'm getting EPS of Infosys is 20, EPS of Satyam, Tech Mahindra is 30. So higher the EPS, better the efficiency, better the performance. Book value per share. What is book value? Book value means according to balance sheet, what is the value of one share? What is the value of one share? Value of the share. EPS is how much you are eligible to get for one share. Value of share means what is the value of your share in the company as per book, as per balance sheet. It's very simple. Net worth of the company divided by number of equity shares. Net worth divided by number of equity shares. Look at this book value. Book value per share is equal to equity shareholder fund. Equity shareholder fund is nothing but net worth of the company. How do you calculate equity shareholder fund? Asset minus external liability minus preference capital. That's one possibility. Another possibility is directly you can see from the balance sheet. First line is equity shareholder fund. Under that, equity capital, resource and surplus. Only the two together is called equity shareholders fund. If there is any fictitious asset, you have to minus. Suppose preliminary expense is there. Loss on sale of debenture is there in the balance sheet asset side. Discount on issue of share is there in the balance sheet asset side. These all need to be minused from the shareholder fund. The remaining fund you have to divide by number of equity shares. You will get the book value per share. I repeat again, equity shareholder fund divided by number of equity shares in the company on that particular day. This value need not to be the same as a market value. Suppose Infosys you are calculating 20 rupees there as a book value or 1000 rupees there as a book value. Market it may be more than 1000 or less than 1000. It's only a book value. Okay. Next, DP ratio, dividend payout ratio. You remember what is EPS? From EPS, how much I'm giving to shareholder, how much I'm retaining in the business. Suppose 10 rupees is the earning per share. Out of 10, 2 rupees I'm giving as dividend. 8 rupees I'm keeping in the business as a retained earnings. Reinvestment in the business for the next year. So what is the DP ratio now? In this example, what is the dividend payout ratio? What do you call as payout? What you are paying out is called payout. How much I am paying out now in this example? 2 rupees. Out of how much? So what's the ratio? 20% or 0.2, 20%. So dividend payout ratio is nothing but DPS divided by EPS. Dividend per share 2 rupees in my example divided by EPS, earning per share 10 rupees in my example. So 2 by 10 is equal to 0.2. I mean 2 rupees. 2 by 10, 0.2. So 20%. So the same opposite retention ratio. This is payout ratio. Another one is retention ratio. What is retention ratio? How much amount I am retaining from the EPS after paying the dividend. In my example, what is the retention ratio? 80%. 0.8, 80%. How do you calculate? Amount retained per share divided by EPS. Otherwise, 100 minus payout ratio. 100 minus payout ratio. So which is good? Dividend payout ratio we already discussed. But you would have asked a question, sir, higher the dividend, better the performance of money, I told you. But that time only so many questions you asked, but now you are not asking question. Is it really good? I'll give a thought for you. Next semester, another teacher who is going to take you corporate finance will be taking it forward. Just a thought. Please understand, financial management is a regular routine activity based on the transaction happening that is being captured here. We're analyzing. I'm not teaching you how finance need to be managed. I'm teaching you how the finance was managed. Please keep that point. We're going to learn in the next semester how you have to manage the finance. Okay, the result of that is in balance sheet that we're discussing now. Okay, come back to the point. If DPS is more in A company, DPS is less in B company, I already told, I declared that A is good, better. But is it always good? Always okay? Always holding good? When? Why? Why it is no and when it is? EPS more, there is no question. Always there is only standard instruction, standard understanding. More the EPS, higher the performance of the company. That's clear. But come to payout ratio. If the payout ratio is more, Can we say that company is a good company? No, why? It is not investing, it is paying more percentage to you, meaning the company is not having any investment opportunity. When the company will reinvest, if they have more investment opportunity to earn more return than that of what you expect from the company to give back to you, that time they will invest. Keep this much only. Next semester, you keep this point and discuss with your teacher. This is called dividend earnings management. This is called earnings management. Earnings management. Company, how to manage the earnings of the company. There are three things are there. One is financing decision that talks about equity, preference, retained earnings. Another one is investment decision that talks about your fixed asset, current asset, all these things. Okay. Another one is dividend decision that's talking about your how much you keep, how much you pay. Just to keep this in mind. Next year, next semester, you can discuss in detail with your other teacher who is going to teach about the corporate finance. Okay. So dividend payout ratio, retention ratio. Okay, this is very, 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 very important ratio. That is market ratio. Actually, this is called market ratio. We are really going to the market and taking the price and comparing how the price is. Price earning ratio, PE ratio. We will call it as PE ratio. Market price of the share divided by EPS. You know already what is EPS. We calculated. We learned how to calculate EPS. That EPS is going to be used as a denominator here for dividing the market price per share. Okay, all of you take your phone, quickly check with the Infosys company's market price today. Infosys company's market price, maybe yesterday, not yesterday, day before yesterday. Today and yesterday was holiday, no? Quickly, maybe 900,000.
1,000. So sorry,
1,000.
1,800 or something per share.
Okay, assume 1,800. 1,800. 1,800. Look at this. 1,800 is the market price of Infosys divided by earning per share. Suppose assume earning per share in Infosys is 1,000. Earning per share is 1,000. So what's the answer? 1.8. Assume another case. 1,800 is the same market price of Infosys, but Infosys is earning only 100 rupees. What's the answer now? EPS only 100. Market price is 1,100, 1,800. What's the answer? What's the price earning ratio? The same mathematics. Do and
0.8.
18. First one it was 1.8. Correct? No, 1.8. Now it is 18. Now can you connect this logic? Which one is good for the company? Price earning ratio 18 or 1.8? If you are not able to take a decision of 1.8 and 18, go back to the data. What's the data? By buying equity share of Infosys, by spending 1,800, in first case, I am able to get how much? 1,000 rupees as earning per share. If I buy one equity share of Infosys by spending 1,800 rupees, I am able to get a return of 1,000 rupees for 1 year. Another case, same logic, another case, hypothetically. If I buy by spending 1,800 rupees to buy equity share of Infosys, but Infosys is giving me an EPS of only 100 rupees. So which is good? When the company is said to be good company. First case or second case?
P ratio 1.8.
P ratio 1.8. Another case you take, same example. 1,800 rupees I spent to buy the share. I bought it. I was waiting for 1 year. I'm getting 1,800 rupees as EPS. That time your ratio is, P ratio is 1. So now you tell me which is good, P ratio of higher or P ratio of lesser? Huh? Higher is good?
Lesser.
So they are not willing to have money. They want to Infosys to be growing. Huh? See, sir, simple. I am spending 1,800. I am getting 1,800. But my share is there. I am not getting my share sold. I have a right in one share right in the company. That is still continuing. But for my sacrifice of 1 year, they are giving me, not giving means they're not giving you in cash. They have earned for one share as 1,800 rupees. The earning of the company for one equity share is 1,800. Second case, earning is only 1,000. Third case, earning is only 100. So which is good. In all the cases, investment remains same. Market price, I just kept it same for just understanding. Okay. Same. But earnings are highest, higher, and normal 100. So which is good now. No, you're telling about earning. Tell about P ratio. Lower. Lower the P ratio. Okay. So if you are buying a share, any company share, you have to look at this ratio and you have to buy this. One of the ratios you have to look up before you buy a share. So any companies, if you want to buy, you have to look for a company whose price earning ratio is less. This is what we wanted to discuss today. We have done with all the ratios. So many problems are there. I mean, numericals are there in this particular file. These are the entire ratios what you discussed so far today. Okay. You please practice these questions. Okay. Theoretically and logical understanding is done, that I have done now. Number. Two things. One is understanding about what to be included in numerator, what to be included in denominator, and how do we interpret that, and how do we calculate normal calculation. Somebody cannot even divide 4 by 4. 4 by 4, how much, madam? She's telling, sir, this much also your student may not be knowing, you are thinking 4 by 4 is equal to 1. Somebody will take a calculator. That need to be practiced. I mean, the arithmetic, you have to get practiced, and the logic of including the numbers in numerator and denominator to be practiced. Remaining all I have done for you in the class. Okay, before we close it, another 2-3 minutes, any doubt? Okay, assignment, whatever we have done so far is assignment for you. Whatever you have done so far, you are going to take a balance sheet of a real company. You are going to take a profit and loss account of a same real company, and you are going to perform all these ratios on your own for the data of that company. That is the assignment number 2. Already assignment link is opened in your LMS. If you have any doubt about assignment, if you have any query about dates, I am the first point of contact. Okay. Individual. Okay. Individual assignment. Date is mentioned over there. Maybe 10th, today is 10th, no? 10th May is the last day to submit. 1 month time I'm giving you. You can create your own company. You can ask them to perform, and you can take their balance sheet also. Okay. Simply telling, take a company, listed company. Any listed company, information in your LMS is very limited. I have given only 2-3 sentences. I'm explaining it to you right now. Okay, if you have any queries, 10th is the last date. Maybe we may be meeting one more time before that. You can ask. I clarify again. Any 2 listed companies you take. 2 listed companies. 2 listed companies. Don't see in Excel, you can include that, I mean, incorporate data. You can just do for one formula you are giving, and then tracking. Maybe you can do it for n number of companies, tracking only. No? Okay. I'm giving only 2 companies. Your tracking is limited. You can just do like that. Huh? Yes. 2 companies. You have to give the balance sheet and income statement in the first page so that I can understand what is the data you have taken. Okay. Reproduce the data in the form of.
Professor, one doubt. Sir, Sudesh here. Sir, you mean to
Yes.
say the balance sheet we have to taken from this Google or somewhere, and from that
No,
we have
no
to
Google,
do
no
the
Yahoo Finance, no somewhere. Only one where is, that is company's website. Suppose you decided to do it for Tata Motors. Go to Tata Motor website, download the annual report, download the P&L account and balance sheet from the annual report. Okay, no money
Done.
control, no Yahoo Finance, no Google. Take it from the concerned company's official website.
Okay, like that 2 companies. we have
Concerned
to-
company's official website. What is that? What is your name? Huh? Prayer Limited. That company I'll go, I'll download. Not with, sir, Dayananda Sagar University will know about this person. I'll go and ask Dayananda Sagar University. They may not be knowing about your real date of birth. They may be knowing only your official date of birth. That kind of chances are there. Just joking. But real term is, go to the company's website and take. That is authentic. That is authentic. Of course, you can go to stock exchange, you can go to other places where they are supposed to give their original data. You can take it, but it is simple. It is that you already done, na, sir. First assignment. No. Our own company. Yeah, that's okay. Your own company means your work. Yes, yes. If it is a listed company, yes. Nobody stops you. Okay. It should be a listed company. Listed company, either in NSE or BSE, Indian listed company. Gentlemen, please understand, Indian listed company. Sir, I like only Apple. You can, but if it is listed in India, you can take. Otherwise, no. Indian listed companies, two companies from the same industry. Compulsorily manufacturing companies or trading companies. No service oriented. Sir, I have taken insurance company, I have taken bank, then I have to take you another 3 hours how to analyze the statement of these kind of specialized business companies. We have not talked about that. If you go to bank, sir, net revenue from operations, sales, sir, sales I'm not finding where the bank will have sales. No, only interest received will be there. Spread will be there. There's no profit spread. There are so many terminologies different from normal manufacturing and trading companies to specialized companies. So take only manufacturing companies or trading companies. Standalone balance sheet, again, standalone. Suppose Tata will be having a conglomerate, it's having group of companies. There will be a consolidated balance sheet. It will have consultancy services, it will allow manufacturing, it will allow trading. No, only one company, standalone company. Okay, Tata Motors, Tata Power, no, Tata Power, no, Tata Motors, manufacturing. Okay, clear to you? Individual assignment, and you can do in Excel, you can prepare in Word, no problem. But finally, when you're submitting, you have to convert that into readable, aligned PDF file, and you have to submit it in the date of submission. Okay, there are so many queries coming in. I may not be answering your queries as now I receive your query. The 2 ticks, blue ticks are there. Yes, of course, it is read. The message is read in WhatsApp, but that does not mean that I may be having time that time alone and I'll give you message immediately. There will be robo sitting at the other end, will give you the message. Your message is received. Thank you for your message. We'll answer you shortly. That kind of arrangement I have not done in my WhatsApp. So please don't, what I can say, don't be worried about sir is not replying. You wait another, you put a question mark. Till your question is answered, you put question mark. Just type question and then enter. Over. Okay, don't think that I'm not answering you. Or you can call me at 8 o'clock, 7 o'clock in the evening. Okay, many of you are sending message and expecting immediate reply. I'm sorry, I could not give 1 or 2 cases. So be patient and wait. I am the final person to give you mark on your assignment. Okay, so please contact me if you have any trouble. If you have any problem, I will solve it. And nothing, it's not a school. Okay, it's not a school to give you punishment or something. You are all matured enough and you have so many years of experience and so many discussion I have from your online friends. They're having so many practical terminologies to use. We don't know really. So what I'm trying to say is behave and expect something with some time space. Give us space and you contact us, no problem. Okay, it's not just assignment given and 0 is marked. Today's environment is not possible. Not only for you, everywhere in our university also, it's not possible. The purpose of education is not punish a student. It's only purpose of education is making you to learn, facilitating you to learn, not giving you punishment for not learning. That gone are the days. Okay, not now. We're facilitating you to learn. Okay, that's it. Any other specific doubt about assignment?
Sir.
Yeah.
Yes, sir. When will be the last date, sir?
When will be the
Last date, submission.
10th May.
Assignment.
10th May. Second assignment 10th May.
Okay, sir.
Second
Okay, sir,
assignment
thank
10th May.
Sir, hi, Nalini here.
Normally it is 11:59 midnight. Normally. Okay.
So, one last doubt. Here is a line with given prepare a report on the financial condition of the company. So financial condition, nothing says about the analysis.
All these four. Financial condition means all these 4.
Analysis. Okay.
Solvency, profitability, liquidity, and efficiency.
Okay, sir. Thank you. Clear.
Okay, I request all those students, those who are away from the campus, please try to join us in the real time in the offline class. Just my request from my personal side. Okay, officially you have some information from the college. But if you are able to come, please come and be with us and enjoy the class in the offline mode also. Okay, that's it about today's class. Thank you so much. If you have any queries, contact me. Okay.
Thank you, Professor.
7, 8, if you are calling, I'm available only to take your calls. 7 to 8 that time, no problem, you can call me. By having some concrete question to be asked, you can call me. 7 to 8 that range, we may be relatively free most of the time. Okay, you can call, no problem, don't hesitate. Thank you so much. See you again. Those are online. Any other questions?
Only small, Professor
Yeah,
Riaz
please.
here, Professor, very apologize, See, one query is that, that is the gross profit, and then because normally we use that gross margin, when you talk about the gross margin, we talk, before that SG&A. But when then gross profit is after SG&A, just please kindly support me to clarify that. Before SG&A, or after SG&A?
What is that abbreviation you're using?
This is selling, general and administrative expenses.
No, margin and profit both are interchangeably used here. So gross margin and gross profit both are one and the same.
Okay, sir. Thank you very much, sir.
Yeah,
thank you very much.
See you all.
Bye-bye, sir.
Bye-bye.